A very pleasant good morning and warm welcome to each one of you present here for today's clause-by-clause discussion on Union Budget 2022. On behalf of Bangalore branch, I welcome each one of you once again for today's event, and I now request our Bangalore branch chairman CA V.T. Shetty sir to kindly escort our chief guest of today's program, CAS Prakash Chen, past chairman of Bangalore branch of SIRC of ICI, and all the resource persons of today's person, CAS Ramasubramanian sir, CAH Padamchand sir, and also CAK Chythanya sir. I now request our chairman to kindly welcome our dignitaries by presenting a floral bouquet. With round of applause, ladies and gentlemen. Round of applause, ladies and gentlemen. Big round of applause. Thank you, Chairman. I now request Chairman to kindly render the welcome address.
Telvigu Namaskara. Hearty welcome to Jnanarjane, Empowering Excellence. Friends, today's yearly very interesting program. This is 19th year we are continuing this clause by clause analysis of union budget every year. This is the 2022 union budget clause by clause analysis of direct tax. Friends, today to inaugurate this program, we are really fortunate to have as a chief guest our chairman in the year 91-92, when this building foundation was laid in that year. He was our chairman. Very humble, a professional, a committed professional, C. Prakash Chen sir. On behalf of Bangalore branch and on behalf of all the participants, hearty welcome sir. Friends, today is his birthday also. Please, friends, since last 18 years, and today I said it's the 19th year of this clause by clause analysis. We have our eminent resource persons. They are really super specialists, I can say. They are the most sought after speakers across India in direct tax. CA Ramasubramanian sir. On behalf of Bangalore branch, hearty welcome sir. CA Padamchand Khincha sir, hearty welcome sir. CA KK Chythanya, hearty welcome sir. All of them reading this new budget from the day one when budget is announced on 21st February. I think they started as soon as that. Every day I think they must have spent 7-8 hours till today early morning. Ramasubramanian said today he got up at 4 o'clock and read. So it means how much time they put to share the nitty-gritties of the union budget connected to direct tax. As on the day of budget we heard that there are no changes in budget tax. I am keeping it the consistency, maintaining all those things our finance minister said. But after going through the details, the devil's in detail, that's what they say. So there are so many amendments. There are curative amendments, retrospective, clarificatory, and many more. And I think the charitable trust or institution takes itself more than 30-40% of the budget amendments. So all those details, as they said, the 6 hours is not enough. They require much more than that. That's what they told me. So let us all listen from them. So the members, you are the reason for this program. Even overwhelming response. As the COVID pandemic is still not fully under control, we made this program is hybrid mode, both on physical we restricted to very minimum number, and a lot of people are joined through virtual. On behalf of Bangalore branch and on behalf of all the participants here, hearty welcome to each one of you. Hearty welcome to those who joined the virtual. Friends, so my term as a chairman of this branch is coming to end. So we have 2 more programs. On 17th of this month, we have indirect tax budget clause by clause analysis, mainly on customs and other issues are connected. Our day program is there on 17th, next Friday. I request all of you to attend that program. Other than that, 21st, we are going to hand over the charge and new chairman is to enter, new managing committee is going to take over the charge. So I request all of you to come on that day too. 21st, we have a half-day seminar on companies law, latest amendments on company. See our current Central Council member MP Vijay Kumar and our local expert CA Guraj Acharya are going to be there on that day. So I request all of you to come and grace that occasion. With that note, once again, hearty welcome to you. Over to you.
Thank you, Chairman. To members, to give brief introduction about our chief guest of today's program, Shri S. Padamchand was qualified chartered accountant in the year 1978 and he is in practice since past 4 decades. He is graduate from Madras University and he did his horticulture work at Khincha and he was also chairman of Bangalore branch of SIRC of ICI in the year 1991-1992. He was also president of Karnataka State Chartered Accountants Association in the year 1995 and also co-opted members of various committees of SIRC and Central Council of ICI. And we are very proud to say that under his chairmanship only our present Bangalore Branch Foundation stone was laid and the building was completed. Thank you so much sir, for so much of a contribution and we welcome once again for today's programs. I now request all the dignitaries on the dais and our managing committee members to kindly join us for lightning of the lamp. I also request Prashant sir to kindly join us on the dais.
सुप्तेषु जागृति य एष सुप्तेषु जागृति
I request our Chief Guest, C.S. Padamchand Sir, past Chairman of Padamchand, to kindly give the inaugural address.
Very good morning, my dear friends and all the members of our Bangalore chapter. My dear members and friends, it gives me a great pleasure to be amongst you for a discussion on the analysis of class by class discussion on Union Budget 22 presented by our own Finance Minister Chythanya on 1-2 in Parliament. Today we have expert and eminent speakers Sri Ramasubramanian, Sri Chythanya, Sri Padamchand Khincha and Sri Prashant Sir, who will be leading the discussion on the today's topic. They are renowned persons and eminent personalities of our Bangalore chapter of ICAI. The important points for this budget is the budget 2022 is focused on digital and technology in sectors like infrastructure, health, education and provision of e-services to the masses. This union budget laid a foundation and blueprint of the economy over Amrit Kaal of the next 25 years from India at 1975 to India at 100. India posted a 9.2% GDP growth, the highest among all economies. We are amid the Omicron wave. The speed of our vaccination campaign has helped dramatically. The FMS stated that Sabka Prayas will continue its strong growth. Budget 2022 has provided a sharp increase in public investment and capital expenditure provision. Strategic transfer of ownership of the Air India has also been completed. The various highlights of the budget is a new provision is introduced to allow taxpayers to update the past returns and include omitted income by additional tax payment. The updated return can be filed within 2 years from the end of the relevant assessment year. The tax incentive period is extended by 1 year for startups. Eligible startup incorporated under ATIA will now get tax benefits up to 31st March 2023. Corporate surcharge is being reduced from 12 to 7%. AMT, alternate minimum tax, is being reduced to 15% for cooperative society. Income from transfer of digital assets such as cryptos is taxed at 30%. No deductions is allowed except the cost of acquisition of the digital asset. Loss on sale of digital assets cannot be set off against any other income. TDS at 1% will be levied above the threshold. Gifting of digital assets will also be taxable in the hands of the receiver. To bring parity between central and state government employees, the Finance Minister proposed to increase the threshold limit for the employer's contribution to the National Pension Scheme Tier 1 account from 10 to 14%. The parent guardian of the differently abled can get a tax reduction on payment of annuity or lump sum during the lifetime of parent or guardian, once the parent or guardian has attained 60 years. Any surcharge and cess levied on the income are not allowed as business expenditure. Brought forward loss cannot be set off against undisclosed income detected during survey or search. With these highlights on this budget, I am thankful to Sri B.T. Shetty, Chairman of Bangalore branch, and his entire team for giving me the opportunity and speak on the occasion. Friends, thank you very much.
Thank you so much, sir, for your kind words and sharing some of the finest updates. I now request all the dignitaries on the dais to kindly render honors to our chief guest by felicitating him. I also request our panel branch committee members to kindly join us on the dais.
Hello. Hello.
I take this opportunity on behalf of the present formal vote of thanks for today's inaugural session. I wholeheartedly thank Chief Guest of today's program, C.A.S. Padamchand sir, for gracing the occasion with his valuable presence and being part of today's program. Thank you so much, sir, once again on behalf of entire participants and also on behalf of Manju Committee members. I also thank all the resource persons who have been kind enough to accept our invitation and coming forward physically to be part of today's program. Thank you so much, all of you. And now we should proceed with the first technical session. To members, to give a brief introduction about our speakers of today's program, we have with us C.A.S. Ramasubramanian sir. He completed CA in the year 1975 and was employed in BHU until 1978 and then in practice. Presently, senior partner in MSSV and co-chartered accountants, practicing both direct and indirect taxes. Has presented papers on direct and indirect tax laws in national and zonal seminars, and also member of group constituted by ICA to prepare the guidance note on transfer pricing. With this very brief introduction, I welcome you for today's program, sir. To give a brief introduction about our Padamchand Khincha sir is partner in Khincha and Co Bangalore with over 30 years of experience in corporate and international tax return, and is commerce graduate from University of Bangalore, securing 5th rank, and has represented large corporate in some of the high-profile cases before various income tax tribunals, and also is instrumental in making critical analysis of direct tax code as a member of team constituted by ICA on the request of CBDT. With this very brief introduction, I also welcome you for today's program. Members, we also have with us Chythanya sir. He is secured 15th rank in All India CA final examination and has completed his articleship in PwC and in industrial training in Hindustan Lever Limited, Bangalore. As a chartered accountant, he has 14 years of specialization in taxation matters, and as an advocate for 17 years in various high courts and Supreme Court. He is also designated as a senior advocate by Karnataka High Court on 14th December 2021. With this very brief introduction, I also welcome you for today's program.
Chairman of our branch, the Ramasubramanian, Chief Executive. my most remote senior from IFSC and whom I consider very safe shelter. And my dear delegates, I would consider this budget discussion culminated with the class-to-class discussion is possibly only occasion in a year for us to, as well as for the learned delegates, to look at various sections with what for our example would have been. More particularly, this tendency is more when the budget is less interesting. If the finance bill were to have many interesting sections, our energy would be devoted to looking at those sections. When you have a finance bill like your FP 2022, where you can find too many exciting sections, just to create excitement where an exit you have to look at all sorts of provisions. That's why I consider this as an exercise, no matter how much we may bore you throughout the day. So this occasion would also have to be thanking Mr. Prashant, who's been witness to the acrimony that we have had for the last 10 days, and also has been to contribute to the discussion. When me and SR's fight, it is Mr. Padamchand and Mr. Prashant are the ones who pull us down. Make us shake our hands all over. And we have had good time for the last 10 days. Now with this, let me start. Taxes. There are no changes in the corporate rate of tax. You have all sorts of multiple rates for a company that are available continuing given in financial year 2020. We have one concession rate at 25% without any rider whatsoever if the gross turnover of the company would not exceed 400 crores for the financial year 2021. This is for the assessment at 23-24, the previous year 22-23, your turnover not of 21-22, but your turnover 1 year prior, 2021 will have to be reckoned to see if it crosses 400 crores. If it wouldn't, then you will get the benefit of 25% rate of tax without any conditions. Otherwise, you will have conditions of 115 BA, 115 BAA, where you'll have 25% and 22% tax rates. You will have to comply with a lot of conditions, where you would not be given the benefit of Chapter 6A deductions. You would not be given the benefit of the additional depreciation, 10 AA benefit, Chapter 6A benefit. So those conditions are not applicable. You will nonetheless be liable to pay at just 25% tax. And if you are into general category, it is 30%. There is no change here. It is just a recap. Calibrated with the surcharge and cess, you could see the rates, moving from 26% to 29.12% if you are an MSME, or from 31.2% to 34.94%, close to 35% if you are company in the general category. Surcharge rates, no change, 0, 7 and 12, and if you are a foreign company, 0, 2 and 5, depending on the status of your total income. For a foreign company, no change. Basic rate of 40% remains. The surcharge of 0, 2 or 5% depending on what the total income of foreign company is. And surcharge and cess included, the tax rate could go from 41.6% to 43.68%. The MAT rate, no change, 15%. Surcharge, no change. So the effective MAT rate for an Indian company or a foreign company would remain. So you would know that for a foreign company, nowadays, there are hardly any circumstances where a foreign company would become liable to pay MAT tax. It would not have to pay tax on royalty, dividend, FTS, etc. It would not have to pay tax unless it is having a permanent establishment with a treaty country, with a non-treaty country, unless it is required to obtain license under any of the Indian regulations to have its operations here. In all of the cases, a foreign company is not liable to pay minimum alternate tax. For the domestic company coming into these two special categories of 115 BAA and 115 BAB, you would know that the rates have not changed. You will have 22% in the case of BAA and 15% in the case of BAB. and the surcharge is flat 10%, you wouldn't get the threshold exemption up to 1 crore. So whatever is your 22% tax and 15% tax, the surcharge of 10% as well as cess of 4% would apply. No minimum alternate tax. So the maximum tax for a 115B AA company would be 25.17, and for BAB it is 17.16. You'll have to be mindful that if you come under 115 BAB, it is not that all your total income would suffer at concessional rate of tax. Only the income from manufacturing activity. The rest of the income would suffer tax at either 22% or 30% if a lower rate of tax under Chapter 12 is not prescribed. So this is how it has to be understood here. One change in the case of cooperative societies, earlier cooperative society would be required to pay flat 12% surcharge after 1 crore. Whereas now, a parity is brought between a cooperative society and a company. So we'll have many other provisions in the Income Tax Act which have brought in good amount of parity between a cooperative society and a company. And here is one case where the surcharge rates are tweaked so as to bring them in line with a company, domestic company. This is one change that has taken place. There is one another section called 115BA which was brought in by Finance Act of 2016, which will provide for a concessional rate of 25%. This section continues to operate with all its attendant conditions. So if you are an MSME with your turnover less than 400 crores, you don't have to bother about this section at all. As it is, you get 25% concessional tax, as I said earlier, without any conditions added. Whereas if you are not, and if your turnover crosses 400 crores, then you have a choice between 115BA and 115BAA. So if you come under BA, it will be 25%. If you come under BAA, it will be 22%, but it will have almost identical conditions which you'll have to satisfy. I would not discuss this because this is an old section which remains without much of a change. So now with this, I'll straight away move on to and just before I go to this, because this is slightly a complex topic, in the first round, there are a few other topics which I need to finish. There are all minor topics which I would just complete. Last year they amended the definition of slump sale under 242C because to overcome Syria case and Bidley Investments case, wherein they have said that with slump exchanges, 50 CA would not come, and gain made on slump exchange, applying Mugdiram Bangur's case and PNB Finance case, would be exempt from tax because computation fails, frustrating the charge. So after this Bharat Bidley case and Syria's case, they have amended last year section 52 within brackets 42C to even bring in any manifestation of transfer as part of slump sale. It need not be only by way of sale. It could be any manifestation of transfer under section 2 within brackets 47, which then would bring in even slump exchange, etc. within the scope of 242C and hence section 50B. So there is one small typo error in 242C, wherein they have said that you would have a transfer of your undertaking as a whole for lump sum consideration that would have been regarded as slump sale, notwithstanding that individual values would have been assigned for the purpose of stamp duty in respect of such transfer ought to have been the words. Inadvertently, they retained the old term, such sales. That's all. So they have just clarified it. It would not have made any great difference because no court would have given so much of weight to the word sales inadvertently appearing at the end of section 50 and under section 2 within brackets 42C. And there are a few amendments which are carried out in section 10. You have section 10 within brackets 4 capital E, which was introduced by Finance Act of 2021, which gave an exemption to a non-resident in respect of income which is derived from transfer of non-deliverable forward contract entered into with offshore banking unit of an IFSC, gift city. This gift city is, projected as a world-class financial center. There you will have one of the players as offshore banking unit. if a non-resident were to enter into any transaction of non-deliverable forward contract with such OBU, offshore banking unit, which is located in an IFSC, the income that would have derived from this transaction would be exempt. This is to encourage people world over to start trading with the OBU in IFSC, whereby OBU would become popular and hence IFSC also would in turn become popular. They've added two more instruments here, offshore derivative instruments. What are these? The derivative instruments issued overseas where the underlying assets are Indian listed shares. And next is over-the-counter derivatives where it wouldn't be done through the exchange, it is on one-on-one outside the exchange. So these two instruments are also brought in within the scheme of section 10(4)(e), and income derived in respect of these two instruments would also be exempt in the hands of the non-resident. Otherwise, he would have ended up paying tax on the premise that the income accrues or arises in India. Then similarly, if there is a unit in IFSC and if you are a non-resident and you would lease your aircraft to the unit in IFSC, the lease rental, which could be in terms of royalty or in terms of interest, if it were a financial lease, would be exempt in terms of section 10(4)(f), and this provision was introduced by Finance Act of 2021. This is again to encourage world-class leasing companies to locate or relocate to IFSC. So you could have a situation of a unit in an IFSC being, like a global leasing company, where the aircrafts flying anywhere in the globe could be possibly taken on lease by it to be subleased to the airline operators. And for the lease rentals it would pay to the owner of the aircraft, it would have been discouraged the owner to be leasing it to the unit if it were to come with the withholding tax. They have made it absolutely tax-free. Because it is made tax-free, the cost of entering into this transaction being tax-free would be quite less. This benefit was introduced last year, is now extended to ships also. It is now extended to ships. So whatever we have understood in the context of aircraft would ipso facto apply to the lease of ship. That apart, they have brought in another section by name 10(4)(g). Another clause has been introduced, clause 4(g) to section 10. So this is a case where you are a non-resident, you have some global, like portfolio of shares, etc., instruments. These are being managed by a portfolio manager, and you will have an account with an OBU, offshore banking unit, in an IFSC. So what does portfolio manager do? He would handle your portfolio. This portfolio is not the Indian portfolio, outside India portfolio, which as a non-resident, if you had a portfolio outside India, you would not have paid tax because you are a non-resident. It's an income which is earned outside India. But then because you would deal with a portfolio manager in an account maintained with OBU, offshore banking unit, in an IFSC, so the profits that you would make would possibly get credited to your Indian bank account. That would mean a receipt in India. And despite the fact that the income accrues or arises or is deemed to accrue or arise in India in terms of 5(2)(b), in terms of 5(2)(a), this being the receipt of income in India would have possibly attracted tax, and that would have significantly disincentivized the non-resident to be getting into this kind of a transaction. For that, they have said, by reason of receipt, you don't have to pay tax, provided it is not an income that is accruing or arising in India or is not deemed to accrue or arise in India, meaning it has to be a global portfolio, not consisting of Indian portfolio. If it is your Indian portfolio in terms of section 911, this income shall be deemed to accrue or arise in India on account of transfer of a capital asset situated in India. Or if they were to be held as inventories, it anyway would have suffered tax because all these inventories would have been located in India, hence an income that does accrue to you by way of business connection. So it would not help you in respect of Indian income, it would only help you in respect of your foreign income. Then there are about 4 sections, 4 clauses to section 10. Clause 8, 8A, 8B, 9. So again, these are the clauses which you would have studied only for the sake of, like exam, because in my last 30 plus years of experience handling taxes, I have not had a single occasion where I had to look at these sections except for studying for myself or for teaching the students during the time I used to teach. So what these four clauses meant, this is essentially for some sort of an international agreement, some technical grant, technical assistances, which would involve a foreign government or an agency recognized by foreign government, which will require a consultant to come here, either the consultant or his employees to come here and get the remuneration from out of the funds made available by the foreign government to the agency, which will then pay it out to you. So that would have meant an income accruing to you or arising to you. This would have discouraged the foreign technicians to come and provide services here. So they exempted not only that income, they also exempted, because of his stay in India, he may become a resident or ordinary resident or whatever. His Indian income would have then been brought to tax, and they've exempted not only his consultancy income which he would earn in India, but also the overseas income which would have been included in his total income by virtue of his status becoming that of a resident thanks to his stay in India. So not only the consultancy income, but also non-consultancy income earned abroad that would have been charged to tax by virtue of a conversion of status into that of a resident, whereby a global income would have been charged to tax in India. Not only that, even a member of family who would have accompanied the consultant, spouse and the children who would accompany the consultant, would stay with the consultant in India and then would become residents. By virtue of their residency, their global income then will have to suffer tax. They exempted even that under section 10(9). Now they've said, come assessment day 23-24, none of these will apply. So either don't come. If you come, pay tax. Don't bring your family. If you bring your family, if those family members become residents and still have global income, they have to pay tax. Of course, subject to the attendant reliefs you get in terms of double taxation avoidance agreement. Now let's go to the most important and one of the hottest topics, that is crypto tax. There are four provisions which have been amended or brought in here. They are spread across the Finance Bill of 2022. So I'm putting them together to have a complete discussion of the crypto tax. Interestingly, word crypto is not used anywhere here. The whole of Income Tax Act, the word crypto is not used. So which are the provisions? They are brought in two within brackets 47 capital A to define what is a virtual digital asset. So this definition is extremely critical, because in order that the other provisions would fall in line and you would get covered, whatever asset which you are dealing with in respect of those provisions will have to strictly qualify to be called as a virtual digital asset. Then you have section 56, an amendment has been brought in here to make the gift of VDAs chargeable to tax in the hands of the recipient. Then you'll have 115 BBH, which will provide for a method of computation of income from transfer of VDA and the rate of tax in respect thereof. And you'll have 194S, which will provide for withholding in the matter of VDA. Although there is no amendment to section 195, you'll have to understand 195 as roping in a situation of a non-resident being liable to pay tax in India on account of transfer of VDA. So as payers to such non-resident, section 195 would apply unamended, but in what context, in what scoping, and what are the attendant issues in relation to the payment to non-resident also will have to be discussed in this scheme of things. Now, so there's a lot which is discussed in the matter of what is cryptocurrency, what are the variants of cryptocurrency, what is this blockchain technology, what is this the distributed ledger. So how much ever you would have heard, I would have heard equal to or less than that, definitely not more than that. So don't ask me any technical questions on this. If you're asking me any technical question, you should first explain in that technology, in your understanding, how it works. Then I would be able to explain you, possibly to my limited understanding, the tax implications associated with it. One important point which you'll have to know is Reserve Bank of India in 2018 through a circular banned dealing in cryptocurrency. And this became the subject matter of challenge in Supreme Court in Internet and Mobile Association of India versus RBI, 2020 SCC Online 275, where Justice Nariman quashed the RBI circular on the basis that it interfered with Article 19(1)(g), read with Article 19(2). It's an absolute ban. It is not just a reasonable restriction. And this absolute ban without a reason would amount to patent arbitrariness, and hence it would offend even Article 14 of the Constitution, Part 3. So on which premise? And also on the premise that while RBI would have possibly have the power to do so, in this case, the exercise of power has not been done properly. On these two counts, the RBI circular banning cryptocurrency is quashed. So now it's a free play. People are in doubt as to whether it's called legal, illegal. And there's a bill that is set to be prepared and slated to come in the next session of the Parliament. And there's the grapevine has it that the definition of what is VDA possibly could have been picked from the draft of the bill. Two, 3 points before we proceed. Whatever amendments which have been proposed here dealing with VDA, virtual digital asset, would apply for the assessment year 23-24, previous year 22-23. And up till assessment year 22-23, you cannot take it that it is not chargeable to tax, except that it is chargeable to tax on the general principles of taxation, which you would know. So it could be charged to tax at normal rates applicable to your particular tax status. It may have to be computed in the normal provisions of the Act, and it will have all the fetters and the benefits and the conditionalities associated with computation of any other income. It could be subjected to some sort of a headwise computation of income. All these, whatever you would understand in the concept of anything else that could be an income, would ipso facto apply to the crypto also up to the assessment year 22-23, and whatever we are discussing would apply only from assessment year 23-24. Look at the meaning of what is VDA. There are 3 clauses here, and 247A says VDA means, meaning this is an exhaustive definition. VDA means A, B, and C. So we will do the easier one first. Look at C, any other digital asset. The use of word any other means which wouldn't come in A or B. Those which would have come under A and B would not fit in as any other digital asset, as the central government may by notification the official gazette specify. So anything that is digitized, whether it is generated on account of cryptographic means, just the fact that it is digitized, which wouldn't have otherwise fit into being in the normal sense called as crypto, normal sense called as VDA, anything that is digital, a digitized software license is also a digital asset. If notified by the central government, will become VDA. It need not have attributes of what a typical VDA should have. Only requirement is it has to be a digital asset not fitting into above 2 categories, and irrespective of what attributes it will have, it has to be notified by the central government. For example, the game tokens which you get may not fit into A, though it is generated in the form of, like cryptography or whatever. It may not fit into A because it cannot be transferred, stored, or traded electronically. But then the central government may notify it, and hence it will become a VDA. So this is the simplest way to understand any digital asset, irrespective of the attributes it will have. The moment it is notified, it will become VDA. This is clause C. Now, can you just allow me to complete this? Once I will finish ABC, I'll take your questions. I only said I'll take your questions. I never said I'll answer your questions. Right. Let me clarify this. Now let's go to B.
No refund if not answered.
See, I always believed the transparency of dealings of SRS, but now I have started beginning to doubt. For him to promise or make a statement that he would not give refund means he has had a cut in the collections. I am not a party to it, I am not aware of it. Now, class B, a non-fungible token or any other token of similar nature by whatever name called. A non-fungible token would be a VDA. In the same line, you will also have any other token of similar nature by whatever name called. So any other token of similar nature, the word similar, it cannot be any token by whatever name called. It has to be any token of a similar nature. So in its characteristic features, it will have to be similar to NFT, non-fungible token. It may not be called as NFT, it may be called by any other name, but in its attributes, it would match the NFT. Otherwise, the word similar would have no meaning. But then there is a problem here. They have said an NFT or any other token of a similar nature by whatever name called. Having said that, now in the explanation which comes down this section, at clause A, they define what is NFT. They say NFT means such a digital asset as the central government may by notification the official gazette specify. So any digital asset, whether it will fit into being called as NFT or not, but notified as NFT by central government will become NFT. Any digital asset may be called as NFT by central government. If not so called, though it is NFT, it will not become NFT in its meaning. Therefore, in order that something is called as an NFT, it is important that it has to be notified by central government. Okay. Having said that, the latter words in clause B or any other token of a similar nature by whatever name called. This will render OTOs the requirement of notification. Rather than that, they could have just defined NFT itself as saying any digital asset notified as NFT by central government. That's all. That would have been sufficient. I think they have, as a measure of over caution, had a lot of surplusage here to say that NFT, it has to be notified. Any other token of similar nature need not be notified. Now, NFT need not have attributes of NFT. By virtue of notification, it will become NFT. Anything else will also have to have those attributes which are notified to be an NFT, which may again not match with the attributes of what an NFT is. So this causes a whole lot of complication. And this may make an NFT not an NFT, a non-NFT an NFT by virtue of this. This could be an issue. Now, you may ask me, what is the significance of B and C? Significance of B and C is that it would not have to have the essential attributes which are found in A. If your case doesn't come under C, if your case doesn't come under B, then your case could come under A or not will depend on whether that case will have the attributes which are enumerated in clause A. Now here is where the toughest challenge, to understand the English of it and then try to make a sense out of it. So what does this clause say? Any information, code, number or token. It could be an information, a code, a number or a token. See, what token is also coming here. Then you may wonder why in B they have said any other token of similar nature. The distinction is when it comes in B, it did not satisfy the attributes of A. This has to be kept in mind. Now, an information, code, number or token not being Indian currency or foreign currency. So Indian currency or foreign currency is defined on the basis of how it is defined under FEMA Act, clauses M and H of section 2 of FEMA Act. Even currency is defined in clause H of FEMA Act. Once it's a currency, it has to be an Indian currency because meaning of foreign currency is any currency which is not an Indian currency is a foreign currency. So the moment something is called as currency, it would not be falling within the meaning of 247A. In fact, FM Nirmala Sitharaman's interview, she has said that we call something as currency only when it is issued by central bank. Anything not issued by central bank is not currency, and we intend to target those assets and subject them to tax as VDA. So that is the expansive mindset, whereby anything which is not issued by the central agency is to be intended to be brought in within the meaning of VDA. If it would not come within the attributes of clause A, it will either be coming under clause B or under clause C, but it will be regarded as VDA, is where you could possibly expect the kind of notification that would then be flowing out from the government's box. Now, so currency, whether Indian currency or foreign currency, will have to be excluded. And how it is to be generated? This information code, number or token is to be generated through cryptographic means. So some of us may not know what is cryptographic means. Don't bother, because they have said generated through cryptographic means or otherwise. Doesn't really matter. Doesn't really matter, or otherwise it has to be generated. And this information code, number or token may be called by whatever name you may take a fancy to call it for. Doesn't matter, call by whatever name. But it has to provide a digital representation of value. This token, this number, the information or code will have to provide a digital representation of value. And then it says exchange with or without consideration. Look at the language. How can there be an exchange without consideration? What is exchange? I give something to Narendra, Narendra will give something to me. Is an exchange, barter. How can there be an exchange without a consideration? So consideration goes inherently with the word exchange. So there again, like lacuna in drafting. But then this, which will have a digital representation of value, will come with a promise or a representation that it is not just the digital representation of value, it has an inherent value, or it functions as a store of value or a unit of account, and it is useful in financial instruments, financial transactions and investments, but not limited to investment scheme. And then most importantly, it will have to be capable of being transferred, stored or traded electronically. This is a very, very essential attribute. If anything and everything which wouldn't come in B and D, B and C will have to come under A. Apart from the fact that it has to be in the form of an information code, number or token, howsoever generated by whatever name called, and it have a representation of value, and howsoever it is transferred to you, and it may have inherent value, all that. But end of the day, it has to be capable of being transferred, stored or traded electronically. If this attribute is missing, it wouldn't fall under A. So my suggestion is that whenever you have to test in a given case whether it will fit in under A or not, irrespective of the earlier attributes, which are very generic in nature, the ending words of clause A are extremely critical, and you'll have to test this as well to see as to whether it will fit into being called under A as a VDA. So this broadly is the definition of VDA. And before I would have a suggestion that would I take a questions after I run through other sections as well relating to this? So our chairman suggests that I'll have to take the questions because he's too eager to see me failing to answer your questions. Yes. Huh? Yeah. No. That's the whole idea, sir. Why did I ask you to ask the questions at the end? So that you would forget and I wouldn't have to have the embarrassment of not being able to answer a question. Yes, sir. Please tell me. One by one. We'll take one by one. So you swipe your credit card, correct? You get points. These points could be used at select outlets, correct? select outlets, subject to terms and conditions, correct? Now, your question is whether this would come as B, C or A, correct? It wouldn't come under B and C because it is credit card itself. Credit card as such would not come because it will fit into meaning of currency. It will not come. Now, your question is not on credit card. Your question is, what's on? Your question is the points that you earn by swiping the credit cards. So let's say you have about 5,000 rupees worth of points. Now we'll have to test it on the basis of it will satisfy the attributes of A. Is it a number?
But actually 5,000 worth of points means maybe it should be 15,000.
Whatever it is, doesn't matter, sir. So whatever B is worth, let's not get into this worth. Just to be simple, I have mentioned 5,000 rupees worth of points you have. Points may be 5,000, points may be 50,000, points may be 500. So 500 points worth 5,000 rupees, okay now? Now, is it an information? Is it a code, number or token? Agreed? Howsoever it is generated, agreed? Correct? By whatever name called, agreed? By whatever name called, you call it as points or whatever, doesn't matter. It provides a digital representation of value because 500 points is worth 5,000 rupees. Now, it comes with or without consideration. It has come as a consideration for you having swiped it, no problem. And it has promise or representation of the inherent value it has because it comes with a promise that you can swipe, use it elsewhere to the extent of 5,000 rupees. Up till here, so far so good. Now, can it be transferred?
It cannot be transferred, but I have been.
What? Just answer this question. I'm trying to answer your question, so you just have to confine to answering my question. Can it be transferred? Can it be stored?
Yes.
Yes, up till some point in time, till it lapses, it can be stored like any other chattel. Now, can it be traded electronically?
No way.
It cannot be traded electronically. Now, look at the ending words here. And can be transferred, stored or traded electronically.
Or.
I'll come to, don't worry, sir. We are also used to using these words and or etc. We'll come to. Now, can be transferred? No. Can be traded? No. Can be stored? Yes. Now, the question is, would you read this or as conjunctive or disjunctive? Okay. Usually or is associated with the meaning that is disjunctive. But there are situations where courts have said that when you are dealing with an asset, to have a set of attributes merely because the word or is used in between, that would not necessarily make it disjunctive. It may have to be in a given case understood as conjunctive. In my humble view, it has to be understood as conjunctive because the idea of tax of VDA is where they expect income to be generated out thereof. Here is a case where the points which I've earned are something which I can only store. But the essential attribute of transferring it or trading it electronically do not exist here, and hence, in my view, it may not fit into being called as VDA. However, the caveat is somebody may take a view, no, the law has to be read as it is. It is absolutely clear. R has to be read only as R in the normal plain English, in which case somebody may say that it could even be regarded as a VDA. Now, assuming the other side is successful to call it as VDA, then hold on to it as a VDA for a while as we examine 115 BB H and 194S. We will discuss how is taxation of this handled. Any other questions?
Fall into the same category.
Whatever I explained here, unless it has a different variant, same thing would apply. Any more questions? Yes. Now, there are a few more variants which you could possibly look at. 7 o'clock? 7 o'clock.
Scripts received on exports. That's it. Scripts received on exports.
Yes. There are two ways of understanding it. The export incentives are already coming under section 28 clause 3, 3A, 3B, 3C. That doesn't mean it should not come as VDA, because obviously revenue may want to call it as VDA so that 115 BBH will come to tax it at 30% without the benefit of expenditure. Then again, when it is an export incentive script that comes to you, if it is having all the attributes of A, the last aspect again will have to be seen. Is it something that can be transferred? The answer is yes. Scripts are amenable to transfer. Something that can be stored, yes, up to a limited period of time till they lapse. Something, if they don't lapse, fine. If they're not transferable, fine. So that's fine. I am only looking at those which are transferable, those which could be like stored, those which could be traded electronically again. Then if these conditions are satisfied, whatever I explained in the case of the incentive points which will generate as a result of swiping your credit card would also apply. However, one another point which I have to tell you here, that there is a proviso to 247A, that is also important. The proviso says the central government by notification of the official gazette exclude any digital asset from the definition of VDA, subject to such conditions as may be specified. So the querist has asked a very important question, where certain assets which are already subject matter of tax in the normal course will also have the attributes of VDA in terms of 247A within bracket small a, that could enhance the tax, which may not be the intention. So it's high time you make a representation on this part to the central government to issue a clarificatory notification to have all these assets excluded from within the meaning of VDA. That's something which you'll have to look at. Otherwise, you'll have the difficulty of having to pay tax at 115 BBH. Yes. I would suggest, I think, just hold on for a while, because there are so many other topics which you'll have to discuss. And anything else during tea break also, you can, you're most welcome to come and ask me here. Now, a couple of other issues. See, anxiety is that, we'll have to cover these topics, some of them which would be important. The transactions which you carry out in Metaverse platform, so you may just look at what is Metaverse. It will give you a separate platform which will allow you to combine different, activities. So there are some transactions that could take place. It's like a parallel economy kind of thing. Would VDA provisions apply? Will depend again on the attributes which I've explained here. Then coins and tokens used in games, if they're not capable of being stored or transferred or traded, then it would not have those attributes as I said earlier. Then there are situations like you may lend VDA. So I have some 100 VDAs, I lend it to Narendra with an interest where he will give me either interest in INR or interest in VDA. So this also is another question that has to be kept in mind as to whether how taxation of this will have to be looked at. Keep this in mind. So these are some of the interesting, issues that could arise. We also do not know as to whether it is to be treated as a business asset or a capital asset, whether this treatment is ever relevant, whether headwise computation is still required or not. We'll examine as we look at 115 BBH. Now let's go to 115 BBH, the extremely important section. As I said earlier, this section would apply only from assessment day 23-24. Now look at this section carefully. What it says is subsection 1, where the total income of an assessee includes any income from the transfer of any VDA. I'll repeat again, where your total income includes any income from transfer of VDA. Stop here. What is the limited scope of 115 BBH? It will apply to income from transfer of VDA. This should immediately exclude lending of VDA for interest. 100 VDAs lent to Narendra who would give me interest of 10 VDAs or 10 rupees or whatever could not be said to be arising from transfer of VDA. And therefore, 115 BBH would not apply in your case. It doesn't mean that it is not charged to tax. Whether it will fit into being called an income, whether 228A would apply, whether it's to be treated as income from other sources, all that is another question by itself. But this section would not apply unless it is income arising from transfer of VDA. Now, take his example. I have 500 points worth of 5,000 rupees, which are earned by swiping my cards in the past. Now, these points I would go and exchange for something else. Assuming that these points are VDAs, assuming, if they're not VDA, anyway, you wouldn't have to bother. Assuming that these are VDAs, and I use these 500 points worth of 5,000 rupees to buy a calculator, is it an income arising from transfer of VDA? Could it be called as a transfer? What is the meaning of transfer? If I transfer a pen to Mr. Padam, the ordinary meaning of transfer is that the pen shall remain as a pen in the hands of the recipient. However, the transfer could have a different meaning if you apply section 2 within brackets 47A, but that is applicable only when it is held as a capital asset. But these points cannot be called as capital asset. These points cannot be called as capital asset. So the extended meaning of transfer of relinquishment of an asset, extinguishment of rights therein, applying Grace Collins principle in 248 ITR 323, these aspects would not apply here. So therefore, when I will have it used to buy out something, a calculator, I would say I have not transferred the VDA because this would not remain as point in the hands of the recipient. There is no recipient, and hence it's not a transfer. So that would address your question of, though in a remote case of it being called as VDA, it may still not get covered under 115 BBH. If not so covered under 115 BBH, whatever is the present law will apply. Are you paying tax presently in respect of points that you swipe? On what basis were you not paying tax? If you hold on to that belief, you will hold on to that belief. If you have to rethink, you rethink. But then discussion of that will be outside the budget topic. So for 115 BBH to apply, it is essential that the income has to arise from transfer of VDA. Now, no. First of all, a VDA to qualify is something that has to have an attribute of being traded electronically. Can it be transferred electronically or not? First, answer the question. No, you don't have to say anything else. Can it be electronically transferred or not? In your limited understanding only. Yes or no? Then it's not a VDA. No. You please understand, what we are debating now is, if something can be, it's not legal understanding. It's a status of fact. Whether in a given case something under law is transferable or not. We are not here to discuss those aspects. Please understand. We are here to discuss the applicability of VDA's definition to it. This has to go on the basis of certain set understanding. That set understanding will have to be clear. Otherwise, we will debate into something else. That's why I'm asking you, in your limited understanding, is it something which can be electronically transferred or not? If not, it is not a VDA. Then the question of you having to travel to 115 BBH would not arise. If yes, it is a VDA, then you go to 115 BBH. Now, his question has given rise to another important aspect. Something could be a VDA by virtue of notification or whatever, but need not be eventually electronically transferred. See, it has to have an attribute of being traded electronically. It doesn't mean it has to be necessarily traded electronically. Then the question is, can a digital asset be traded otherwise than electronically? Will be another issue. But whatever be it, what I'm trying to say is when it comes to 115 BBH, from the transfer of VDA, you don't have to then necessarily think it has to be transferred only electronically. The moment it is a VDA having those attributes of being capable of electronically traded, stored, or transferred, howsoever it is eventually transferred and you get some income, in the remotest possibility, you have traded on a non-electronic basis and earned some income. Then also 115 BBH should apply. Now, if it were so, then what this section says is the income tax payable shall be aggregate of. This is very similar to 115 BBC, BBE, etc. This particular income will suffer tax at 30%. And the rest of the income would suffer tax at the rates that are normally applicable to you. So they card it out, the allocate portion of your total income to the extent it is relatable to income from transfer of VDA will suffer tax at 30%. The rest of the income will suffer tax at normal rate. So far, so good. Now look at subsection 2. It is extremely important. Notwithstanding anything contained in any other provision of this Act. A. No deduction in respect of any expenditure other than cost of acquisition or allowance or set off of any loss shall be allowed to the assessee under any provision of this Act in computing the income referred to in clause A of subsection 1. What are they trying to say? I am not going to allow any deduction towards any expenditure except cost of acquisition. I am not going to allow any allowance. I am not going to allow any set-off of any loss under any provisions of this Act. So that means, in simple, what they say is, notwithstanding anything contained anywhere in Income Tax Act, in computing income from transfer of VDA, you will not get any deduction towards any expenditure except the cost of acquisition. You will not get any deduction towards any allowance, which will include your depreciation allowance, etc. You will not get any deduction by way of set-off of any loss under any provisions of this Act. It will not be allowed. Now, look at B before I come back to the questions that arise here. Look at B. No set-off of loss from transfer of the VDA computed accordingly will be allowed against income computed under any provision of this Act to the any other provision of this Act to the assessee, and such loss shall not be allowed to be carried forward to succeeding years. What it says, if you are to get a gain, how the gain has to be computed? No benefit of deduction towards expenditure except cost of acquisition, allowance, set-off of loss under any provisions of this Act. You get 30% tax. Supposing this were to result in a loss, in this scheme of things, you were to end up with a loss, such loss which you have got cannot be allowed to be set off against the income computed under any other provisions of this Act. It is not available for set off. You have other provisions of the Act. You have other capital gain. You have other business gain. You have salary income, you have income from other sources on one hand, your VDA loss on the other hand. This VDA loss on the other hand cannot be allowed to be set off against income under any other provision of this Act, number one. And because it cannot be so set off, it will remain as such, you cannot even carry it forward to the subsequent assessment here. Now with this scheme of 115 BBH, we will look at how it is to be computed. Firstly, how do we compute VDA income? We'll have multiple VDAs of multiple varieties. I may be doing it as part of my regular systematic activity of trading. I may be doing it as an investor. The language of 115 BBH says where the total income of an assessee includes any income. That means it envisages firstly the computation of total income. And the total income should consist of income from transfer of VDA. So if you stay up to subsection 1, it says first to apply the provisions of the Act. First you apply the provisions of the Act. That means you'll go to section 14. They'll classify it under various sets of income. Then you compute it. Then it will all be aggregated. It will be subjected to the process of set off, carry forward set off, all that you do. Then it will sit as part of your total income. So first you see whether your total income consists of any income from transfer of VDA. For doing it, you have to undergo the ordeal of all these computational hassles. Then subsection 2 says, in computing that income referred to there, don't allow any expenditure except cost of acquisition. Don't allow any allowance. Don't allow any set off of loss under any provisions of this act. So there are two ways of looking at it. One is, I have various incomes. I have the VDA also. I will first decide how am I holding this VDA as a capital asset or as stock in trade. I'll put it accordingly under section 28 or 45 as the case may be, or under 56 as the case may be. Then I'll start computing it. So if it were a stock in trade, I'll put it as business income. But then what expenditure could be allowed over there? I will infer the explanation below section 28 that if it were a speculation business, it has to be treated as a separate speculation business as such. So I will infer that kind of understanding and then don't allow anything other than cost of acquisition, admin expenses, depreciation, no. I will then get a portion of my business income as VDA. So from my total business profits, which is sitting as part of my total income, I'll take this portion out and then subject it to tax at 30%. Similarly, if I were to hold it as a capital asset, then I'll put it at a 45. Then I'll claim only one expenditure. What is that? Cost of acquisition. Question is whether I can index it or not. If you are capable of putting it under section 45, and if you are able to sustain the computation under section 48, it is substitution of cost by indexed cost. The indexation is not an extra benefit that comes to you. In terms of proviso to section 48, it is only substitution of a cost by indexed cost of acquisition. So if you are successfully able to bring it under computation of capital gains, it's immensely possible for you to argue that indexation also should be considered, because it is nothing other than the cost of acquisition substituted by an indexed cost of acquisition. That's the understanding. But then you would not get anything else. Incidental selling expenditure which you would have claimed under section 48, no other expenditure. However, can you claim 54F? 54F is neither an expenditure nor an allowance. It is a saving to section 45. Look at section 45, save as otherwise provided under section 54F. So it's neither an expenditure nor an allowance. So in a given case, it may be possible for you to argue that you can even claim the benefit of section 54F. If you are able to successfully argue that it is held as a capital asset and the headwise computation is not barred under section 115 BBH. It doesn't as such bar. It only says, first of all, it says your total income has to include income from transfer of VDA. The next question is, you'll have multiple VDAs. Some may be held in the portfolio as an inventory. Some may be held in the portfolio of capital asset, like the board circular 4 or whatever, in the context of shares, how it has to be treated. Your existing treatment in a books of account will have to be respected. And how long will you have to hold VDA for it to be short-term, long-term? It has to be definitely 36 months above for it to be held, regarded as a long-term capital asset. All the attendant, circumstances which are given in explanation below 242A may also apply here. All subject to our understanding that headwise computation is permitted. This is one view. The other view is that there is no recognition of headwise computation. You just ignore it, compute your total income. You just ignore the VDA gain, compute your total income. Then come to VDA gain. Don't put it under any head. Directly do the computation under 115 BBH. Let us say your all other incomes is about 10 crores. Where you have ignored VDA. So that means you not put it to headwise computation. Now you have a VDA gain of about 1 point. You have had VDA of 3 crores, sold for 2 crores. there's a gain of arithmetical gain of 1 crore. And then you would say, I will not go into headwise computation. I will not bother about heads of income. I would only take 3 crores the consideration minus 2 crores. That's the only cost that is allowed now. 2 crores is the cost. I'll have 1 crore of gain subjected to tax at 30%, and that's it. That's another way of interpretation. While I subscribe to the first method of interpretation, SRS appears to subscribe to the second method of interpretation. After we debated sufficiently long enough, we shook our hands and said that we'll stay with our respective opinions. And who brokered the deal? Prashant GS. By only saying that, we will move to next topic. Because this was not ending. We had to put an end to it. Just hold on. Let me just finish this. Now, next aspect that would arise for consideration here is, look at the bar. What is the bar? No expenditure except cost of acquisition. Now you have to hear me carefully here. No allowance, no set off of any loss computed under any provision. They have not said any other provision. Please look at this carefully. Computed under any provision of this act. Now, let's take, I have two VDAs, two distinct sources, source-wise computation. One, there is a gain, another, there is a loss. If you have to accept my logic of headwise computation, then I'll apply section 70. When I go for section 70, I will go for inter-source set-off under the same head. But then they say no set-off of loss is permissible under any provision of this act, which inter alia includes section 70 as well. And it's barred. On the other hand, if you subscribe to the other view that I don't go to headwise computation, I will simply take all my VDAs as one single source. Multiple VDAs as one single source outside the headwise computation. So there is therefore no source-wise recognition at all. I'll merge all of them and I'll then see the arithmetical difference, and it will then get combined, and automatic setup would then take place. So that is another possibility. If you would agree with the first line of thought, no. Even intra-head setup is not permissible. If you would agree with the second line of thought, it may be possible for you to argue that I'm not setting it up under any provision of law. I'm only doing it under this section where I'm treating all VDS as one particular category. There is a case for claiming intra-head set-off. Just one sec. Just one sec. And then it says, look at the language of clause P of subsection 2. What it says is, the loss that arises under the VDA cannot be set off against income computed under any other provision of this act. You would see notably the difference in the language. Here they say any other provision. But when it comes to computation of income from VDA transfer, they say any provision of this act. The word other could make a notion of difference here. Yes, sir. Yes, sir. Please tell me.
Block. So if that is done, then interhead adjustment will be denied on that source.
It's not interhead. It will be intrahead or intersource, as the case may be. Yes. Now, any questions on the working of 115 BBH? Just one second. Yes, Tarun.
Would it be considered as a digital?
See, what is derivative? Like your options, right? They have some underlying asset, correct? So how is it? Can it be stored electronically? Yes or no?
Yes.
Can it be traded electronically? Can it be transferred electronically?
Options can be traded?
Options can be traded electronically. Yes. So it will have those attributes, correct? Now come back to 247A. Is it an information? Is it a code, number, or token? Okay. It is not definitely currency. And howsoever it is generated, doesn't matter, right? It provides a digital representation of value. Does it provide a digital representation of value?
Contract is true. It has underlying value is derived to a premium.
And does it come with a promise or representation having inherent value? It has inherent value, correct? Whether or not it functions as a store of value, we don't bother about it. And including its use in any financial transaction or investment, but not limited to investment scheme, doesn't matter. So, and it can be transferred electronically, it can be stored electronically, it can be traded electronically. It appears to have all the attributes of 247A clause A, and the only recourse to is to have a notification issued under provised.
But if that's the case, then even securities held in demat also will get the same attribute. Unless the entire securities are excluded, which are electronically held today, all the securities will get covered in this definition.
See, the difficulty could be security may not be an information code, number, or token. See, what they essentially look at derivative versus the securities, my limited understanding, that there has to be just an information of a store of value. Okay, your share certificate in a demat, is it just an information of a store of value, or that itself is value? See, in the case of derivative, it has an underlying asset. But in the case of a share in a demat, that itself is the asset. Can you read this that far to even rope that in, whereby you would relegate it not to an asset, but just an information which is a store of value, or just a code or a number or a token which is a store of value? So I think some meaning will have to be given to it, so that our understanding of this wouldn't take it to a level of absurdity. In a very, very high literal sense, you may say anything is an information. Your sale deed is an information. See, after all, your sale deed of an immovable property is an information. Absolutely. If in, metaverse platform, you could even have the land deals done is what I was told. I don't know how it works, but yes. So what my suggestion is, let's look at the attributes of A to the extent where it would not take it to an absurd proportion, where it wouldn't, reason out by applying common sense, is where we'll have to stop. Yes. Any more questions? Physically, before I take Prashant's questions on virtual mode. Yes, Prashant.
Is it unfair and arbitrary not to allow set off and carry forward of loss for the VDA? Is it infringement of fundamental right of Article 19(1)(g)?
They don't bar you from trading in it. So you don't go to Article 19(1). See, we have in our Constitution Article 265, which says that there cannot be levy of tax without the authority of law. But then the international jurisprudence, the tax collar, coolie writes, it is the inherent right of any sovereign state to levy tax. It need not be something that has to be vested in the state to do it. So therefore, they can always tax you as long as tax is not taking it to the proportion of being confiscatory, whereby it ceases to be tax on income. It will take away your property, may offend your Article 300 capital A of the Constitution, your constitutional right to hold property. But to allow set off, not to allow set off is completely, even to claim set off is not your inherent right. It is vested in you in terms of Section 70. So Parliament has sufficient latitude, as is held by various courts across the country, to levy tax in the manner they think fit. In the scheme of things, they need not allow set off. So the question of it being arbitrary, etc., would not arise. Arbitrariness would arise only when you are subjected to a class legislation, but not when there is a reasonable classification. The virtual digital assets are all put into one category. Which will have characteristic features which are distinct from others which are not put into that basket, and which are similar to other items that are put into that basket. That's it. I think we'll stop there. Yes. Deduction of any expenditure or allowance. So what 115 BBH2 says is no deduction in respect of an expenditure or allowance or set off. So Chapter 6A should be available, provided which section you are looking at. See, if you look at ATC, see, chapter 6A is not a point to be reckoned for computing total income. Like, for example, you look at, just a minute, I'll answer your question, just a minute. They say your total income should include income from transfer of VDA, correct? That means you will have to agree with the, just a minute, you'll have to agree with the first proposition that you first subject it to headwise computation. You don't go to second proposition. In the second proposition, question of chapter 6, etc. would not arise where you would have ignored that 1 crore of digital income. You would have computed over 10 crores of a normal income. Are you able to recall two propositions which I have explained? So what I'm trying to say is your question may possibly arise in the first proposition. It may not arise in the second proposition. Because only in the first proposition, you go up to the stage of computation of total income, which will then inter alia include chapter 6A deductions, etc. Let us assume you stay with the first proposition for a while. You do headwise computation, then you go to chapter 6A, correct? You go to chapter 6A, you will allow deductions, you compute it, it will still have a portion of it represented by income from transfer of VDA sitting as part of a total income. Agreed? Now come to subsection 2, clause A. What they say is, in computing that income, I would not allow you only 3 things. What do I not allow you? Expenditure. Chapter 6A is not an expenditure. I would not allow you allowance. Chapter 6A is not an allowance. I would not allow you set up of loss under any provision of this act. Chapter 6A is not even that. And therefore, there is no bar in claiming chapter 6A deduction. Just a minute, Surendra, let me complete the sentence. There is no bar in claiming chapter 6A deduction under the first proposition. Now, if we come to the second proposition, where you would have already computed the total income, you would have already run through the process of whole system, ignoring VDA gain for a while, and then do it separately under the second proposition. Then they say, in computing that we would not allow you 3. The question of allowing chapter 6A again therefrom doesn't arise in the very scheme of things, is my understanding. Yeah, now tell me. Yes. See, I'm not saying it is not forming part of total income. I guess that is where you possibly missed what I was trying to say. Ultimately, a total income will be computed. How it is computed? Will you have top-down approach or bottoms-up approach? Ultimately, it is forming part of a total income. No one is saying just because it is computed separately, it is not part of a total income. In the scheme of computation, there are 2 methods to be followed, or 2 methods which could be thought of. One is bottoms-up approach, where you start from the headwise computation, eventually reach the total income. One is you do a hybrid approach, rest of the income go up this way. When it comes to VDA income, just do it parallelly, then put them together, call it as total income. Ultimately, it forms part of total income. Exactly. You take, for example, lottery income. You take, for example, 115 BBE you take. Yeah. There's no difficulty at all. Only problem with this is these items are immensely capable of falling at the heads. But 115 BBE, cash credits, etc., that the language is a little different. They will not even allow any other, it's not exactly worded on the similar line as 115 BBH. 1. 2, it would come after the headwise computation over, and there is a legal debate as to whether those cash credits, etc., will come under headwise or will have to be without a head of income. So those debate could arise in respect thereof. Yes. And just to complete this, if you go to 115 BBE for a while, because this has to be gone in because we will have later on 79A, which will also have to be understood along with 115 BBE. So what they say is, if you look at subsection 2 there, notwithstanding anything contained in this act, no deduction in respect of any expenditure similar to this allowance or set off of any loss shall be allowed to the assessment any provision of this act in computing income referred to in 115 BA 1 and 7 are almost identical. Basic exemption for no, you would not get basic exemption. You don't get basic exemption at all because that's the scheme of it. If you look at A and B, only balance will have to be charged tax at normal rate. What comes under A will have to necessarily suffer tax at flat rate of 30%. You would not get the benefit of initial exemption. There are no provisions analogous to 112 here, or maybe even 111A, which will provide you basic exemption if you have to have only that income. Yes, any more questions? Yes.
Both the, how those expenditure will be allowed.
If I and you share the same building, incur common expenses, how we would have considered it respectively?
No, I'm saying.
I'm just asking you this question. How would you have considered it? We have a secretarial staff salary, we would have split it. With respect to articles under U and B, we would have proportionately taken it, right? Same logic would apply.
Means food expenditure cannot be claimed.
I don't think so. Yeah. Yeah, entire expenditure could it be claimed? If you have incurred expenditure in the case of VDA, it cannot be said to have been incurred wholly and exclusively in connection with other business. Then we get into larger debate of Rajasthan State Warehousing Corporation 242 ITR 545, which gave rise to what is section 14A, common source. For a while, we will not get into it, but it's a very important question, very important question, where he says, can I lump all my to tax under 56(2)(10), it is not without consideration. It's not receipt of VDA without consideration. So it's come to me. Now I transfer it to Narendra. What does 115 BB8 say? No deduction except the cost of acquisition. Does it have a cost of acquisition or not? The answer is yes. Can it be determined? The answer may be very difficult. We don't have a provision similar to 50D which talks about the full value consideration, which is unascertainable, indeterminate, where you could apply fair market value. Here we don't have that. The cost of acquisition, which is allowed to be deducted in terms of BBH, they don't bar it, unlike in the case of 115 BBE, where they ban any deduction whatsoever of expenditure. Here the cost will be allowed. But what are the cost? Cost exists, unascertainable, computation fails, frustrating charge. BCS University's principle could be applied. But how do you know that's the only cost? Then SRS had a point during the course of discussion when we took this up. SRS was saying that you can't say cost doesn't exist. Agreed, cost exists. How to determine? On a reasonable basis. So what SRS says is, on a reasonable basis, you will have to take what the cost is. So that is one view. So I was subscribed to another view saying that, no, cost is not just this. There are so many costs involved. We don't know. how and when, how much of time I have devoted on this, how much of time I was not able to devote on my regular activity. I don't know all this. So there is some cost. Very difficult to determine. I would possibly be working in the night. So we'll put an end to this, and therefore, yeah. Otherwise, we'll go on, and then we'll have charitable trust. I'll just close this quickly. Yeah, we'll finish this because if I again begin post tea, then I will not end till lunch. So, in the interest of other.
That is welcome.
Yeah. Yes, now we'll go to section 56. See what 56.210 says is the property. Under 56.210, you pay tax on receipt of a sum of money, receipt of a property, receipt of an immovable property. Property is defined in explanation the 56.2.7 where it is only a capital asset and named assets. Not anything and everything is a property for 56.2.10. Only the named capital assets. Hear me carefully. Named capital assets. Now they have said your property for the purposes of 56.2.10 would not only be those which are named capital assets, but also VDA, whether or not VDA is a capital asset. Please understand this. Extremely important. Because at the first blush, we tend to think that VDA 56.2.10 would come only if VDA is held as a capital asset. No. Any other property to be called as 56.2.10 case has to be a capital asset. But VDA, whether it is capital asset or not, it is just added to the meaning of property separately under 56.2.10 and not as part of the regular definition of what property is. And hence, therefore, all VDAs, whether you receive it as inventory or capital asset, you are liable to pay it without consideration or for a consideration which is less than the fair market value where the delta exceeds 50,000 rupees, you are liable to pay tax under 56.2.10. How do you get the fair market value? They'll have to go for 11 UA rule to be amended to provide for valuation of this. Now, last section is 194. Yes. And before I go to 194S, if 194S would apply to you only if you are making payment to a resident. If you're making payment to a non-resident, 195 would apply. Under 195, all sorts of payments which you make, not necessarily in respect of income from transfer of VDA. See, all VDA related income, please understand, when paid, need not come under 194S because it is to one stream of income of VDA that arises from transfer of VDA. Whereas when it comes to 195, all VDA related incomes, whether it would arise out of transfer or not in your imagination, whatever it be, we'll not get into that for a while, will come under 195. Point number one. Point number two, 195 would apply when paid to a non-resident in the matter of a sum of money. In kind, when you pay, it is highly debatable whether 195 would apply or not. So in the case of barter exchange where the consideration goes in kind, 195 would not accommodate it, unlike 194S which accommodates in-kind payment. 3. Even a non-resident making payment to another non-resident would get covered under 195 by virtue of explanation added to 195.1 thanks to Vodafone case in 2012. 4. Under 195, the rate of tax at source is determined under section 2 within brackets 37 within brackets small Roman 3, which will then take you to either the relevant sections in Income Tax Act or part 2 of the Schedule of Finance Act. If you go to part 2 of Schedule of Finance Act, while for a non-company it is always 30%, for a foreign company it is 40%, where the tax under 115 BBH, which will apply whatever be your status, is 30%. So there is a gap of mandatory withholding at 40%, whereas tax at 30%, then one has to understand the requirement of withholding as subservient to charge under section 4. So there cannot be withholding beyond what you are liable to pay. So thereby you could be deducting tax at 30% rather than at 40%, but at the risk of facing litigation. So this is how we'll have to distinguish payments to non-residents. Now come to the case 194S. Firstly, it qualifies all payers, resident or non-resident, but can you subject a non-resident to Indian withholding requirement? Narendra, a non-resident, is making payment to Chythanya, a resident, in terms of income from transfer of VDA. Can Narendra be subjected to rigors of Indian withholding provisions? Justice Radhakrishnan, concurring judgment in Vodafone, said you can't. But then they have amended 195 by virtue of insertion of explanation. Similar amendment is not carried out to domestic withholding. Therefore, it is still possible for Narendra to take a call that as a non-resident applying Vodafone, he is not liable to deduct tax when he makes payment to another resident. But if he makes payment to another non-resident, 195 will trouble him in terms of explanation which is carried out. Now, any person responsible for paying to a resident any sum by way of consideration for transfer of VDA shall, at the time of credit of such sum to the account of the payee or at the time of such payment, whichever is earlier, deduct tax at 1%. So you'll have to deduct tax at what rate? 1%. Now there is a proviso. What proviso says? If the consideration which I have to pay to, say, Narendra, I am buying it from Narendra, VDA, I have to pay him the consideration. I could either give in cash. If I give in cash, there is no difficulty, I can deduct tax at source. If I give in kind, I can't be deducting tax at source, or I may give partly in kind and partly in cash. And the partly in kind could be VDA and non-VDA. I can buy VDA from him, give him my land. I can buy VDA from him, give him hard cash. I can buy VDA from him, give another VDA to him. I can buy VDA from him, give him cash partly, another VDA partly, land partly. So you could have all these combinations which you couldn't think of. Then, in which case, what proviso says is, if the cash portion which I'm paying him is not sufficient to accommodate the TDS at 1% on whole of the consideration, are you able to follow me? The cash portion which I paid to him is less than the TDS of 1% on the entire consideration, then before I would release the consideration, I will have to ensure that the tax on this is paid. There's a big gap. TDS is 1%, but if the cash component is less to accommodate even that 1%, I have to ensure what tax is paid. Full tax is paid, not just 1%. So that's the language which is adopted here, which is not something which even at a 194B for lottery price, the proviso also says similarly. What if I don't ensure? I don't ensure. No consequential provision. I'm not required to deduct tax at source. I'm only required to ensure that he pays tax or somebody pays his tax. So all the, like consequential provisions like 201, etc. would apply only when I am liable to deduct and I fail to deduct. I'm not liable to deduct where there's a failure to deduct here. I'm only to ensure. So even 271C, which will deal with requirement to ensure in the context of 194B, would not apply to 194S. So it's only a momentary relief. They're going to amend this. Don't worry. They're very soon going to amend this and bring it in line with 271C to levy penalty where you fail to ensure. And then who is liable to deduct? All payers are liable to deduct, but these payers are split into two categories: specified persons, non-specified persons. Whoever is not a specified person is a non-specified person. Who is the specified person? Individual, HUF, not having business income or having business income exceeding 1 crore turnover, or professional income having more than 50 lakh of gross receipts in the preceding previous year is the specified person. Rest of the category are non-specified persons. And who the payer is, first determine whether it's specified or non-specified. If you're specified, the threshold is 50,000 for you. If you're non-specified, the threshold is only 10,000 for you, right? 10,000 for you. It's 50,000, higher threshold for a specified person, lower threshold of 10,000 for a non-specified person. And the specified person is exempted from TAN, is exempted from highest TDS for non-filer, but not exempted from no PAN case of 206AA. Have you heard me clearly? You are exempted from TAN if you are a specified person. Up to 50,000, you don't have to deduct. Beyond 50, you have to deduct. Exempted from TAN, you are exempted from 206AB non-filer where you have to deduct higher tax, but you're not exempted from 206AA. If you're not a specified person, all the provisions would apply to you. And let me quickly wrap up now. If tax is deducted under this section, in respect of this transaction, tax is not required to be deduction under any other sections like 194Q, etc., which otherwise may have applied. Then, if 194O also would not apply, 206C1H also would not apply. Those provisions would not apply to you. I think with this, yes, one more issue. All this deduction of tax at source will have to be made on the consideration which you pay, right? Many a times you will be buying this in an exchange. You would not even know who are you paying to. Whether he is a resident, a non-resident, you know whether you are a specified person or not. You don't know who the other party is. Many times, it's all so opaque. You wouldn't even know who it is. In which case, how do we go about it? Will you then be deducting to whomever your payment goes, stock exchange, or either the digital exchange, the crypto exchange? Because the immediate person who you know is the exchange. We have a question for which we possibly don't have answer till it's clarified. You have provisions here which say that if there is any difficulty, is there a provision similar to that? Subsections 6 and 7, you have the case of central government issuing guidelines to remove difficulty, which guidelines are required to be tabled in both houses of parliament, which will have then the force of subordinate legislation. So we'll have to await as to how it works. We debated quite a bit of it, and we had to stop because we are not actually dealt with these transactions per se ourselves. So with that limitation, you'll have to understand how this 194S works, and I would thank you very much for having heard me so far. And we'll now take a break for tea and get back as soon as we can.
Morning to all of you. Chaitanya was saying that we always take differing views on any issue. So what I do is, if there are two views possible on a particular section, and if I want to take one particular view, I will tell Chaitanya the other view. He will demolish that view with so many good reasons that I will get a lot of material in support of the first view I wanted to take. So it's this one. Therefore, whenever you ask him any opinion, you give your opinion contrary to what you want. Then you will get the opinion you want. We had a good amount of discussion on the cryptos, currencies, and the crypto assets, the VDA, etc. And it is deemed that all of you have understood what was discussed. Similarly, now we are going to have a discussion on the amendments made to section 1023C and section 11, section 12A, etc. on the basis of for the charitable and other institutions. A number of amendments have been made with reference to these sections. In fact, if you look, 3 sections in this finance bill occupy 50% of the printed material. One is section 1023C, section 11 amendment, then The second one is the amendment regarding the updated returns under 139.8A. And the third one is 144B, faceless assessment. These three sections occupy nearly 50% of the printed materials of the bill. Now, when we come to section 1023C, the memorandum says that the amendments are carried out with three objects in mind. The first one is to have an effective and better control and management over these institutions which claim exemption from taxation. Second, to achieve a parity between the two regimes. They call the 1023C regime and section 11 regime. They want to treat it as one, and therefore they want to have a parity between these two, and they bring in a lot of provisions in section 1023C to align with what is there with the similar provisions in section 11. The third one they say is something which they want to do it in respect to clarify certain doubts they have which have been thrown up because of the various court decisions. So we have to keep this in mind. With this background in mind, if you look at section 1023C, how many provisos are there? Any idea? 22. When? Up to by which Finance Act? So somebody said it is 22. Somebody said 18. Huh? Up to 21. Now, if you say so, when you come to one particular provision, we'll see that the finance bill will say that after the 19th proviso, but before the explanation, the following provisos shall be included. And if you look at that, you will find that there are what are included are now by the Finance Act 22, 20th proviso, 21st proviso, 22nd proviso, and 23rd proviso. And then afterward, there is a proviso to explanation, which is not counted as 24th proviso. You remember, you have provisos to section 1023C, you have provisos to explanation, and you have explanation to provisos. And I am supposed to explain all these things. It is one of the most complicated pieces of legislation. So bear with me if I am not able to come across very clearly as to what I want to say. So if you have any doubt, any contra view, you're, as always, you're welcome to give your. The first amendment, which is to the third proviso to section 1023C, says that where you receive in respect of certain institutions notified under section 80G 2B, that is temples, mosques, gurudwara, churches, and other places of worship, which are notified by the central government there under section 80G. If those places of worship receive any donation for repair or renovation of such places of worship, then such amount shall be treated as the corpus of the 1023C institution. Normally, this will come under 1023C4 or 1023C5 mostly. So therefore, you have this only for those kind of institutions where you receive donation for repairs and renewals and renovation will be treated as corpus. So once it is treated as corpus, what the section says is, provided the three conditions are satisfied. In order to be treated as a corpus, you have to satisfy three conditions. What are they? One is that applies such donation only for the purpose for which it is given. Two, it does not apply to give donations to any other person. 3, maintains such corpus separately, and 4th, invests only in the modes approved under section 11.5. Quickly speaking on this, now the first thing is that whether this is needed at all. This particular explanation 1A, whether it is needed at all. Because if you look at certain decisions on what is the meaning of the word corpus, the courts have held that if any donation is given with a specific purpose, then that itself is corpus. The Karnataka High Court in Sri Ramakrishna Sevas and Trust 357 ITR 771 held that if a donation is given with a specific purpose, then it is treated as corpus. Corpus is not something where you keep it the principal intact and spend only the income from therefrom. So a corpus can also be like a building fund or a fund for a specific purpose. So moment the amount is given for repairs, renewals and renovation of the place of worship, it becomes a corpus automatically. So one way of looking at this, third proviso will automatically takes care of such corpus one, and there is no need for this. But this is something which has been made. The second issue is, the first condition is that you apply it for the purpose for which it is received. So this is an omnibus condition. Look at the second condition. Second condition says that you can't spend it as a donation for others. When I have received something for repair of my place of worship, how can I give it to, and it says that I can use it only for this. How can I give it for donation to others? Why do I need this clause? This is not needed. So this is the third point on this. The third point on this is that we have the requirement of the maintenance of the corpus. Sorry. The maintenance of the corpus separately identifiable. Now, what does it mean? Does it mean that you must open a separate bank account to keep that money and spend for the repairs, etc., only by drawing money from that bank account? Or does it mean that you have to maintain in the accounts separately identified this as a particular corpus? So in our view, it is enough if it is simply maintained in the accounts, this one. As far as the actual deployment of that money in the bank, etc., is concerned, it should be subject to 11.5. So you can have one bank account wherein all your income and other funds flow in, including this corpus amount, but in the accounts, you have a separate account. In the balance sheet, you show this corpus as a separate liability on the liability side, and all the accrued income there also, you can show that. So this is one way of reading this particular clause. The next important thing is the explanation 2 to section 1023, the third proviso is added. This is with reference to general corpus. The amendment which is now made here is similar to what we have in section 11.2, accumulation in the case of a charitable trust. Almost similar, saying that how it has to be done on this. So here it says that there shall be an explanation 2 is already there. Then we have explanation 3. What does it say? For the purpose of determining the amount of application under this proviso, where 85% of the income referred to in clause A of this proviso is not applied wholly or exclusively for the purposes other than this, then the institution shall set it apart for either in whole or in part for application to such objects of the institution. So what it says is like section 11, if you don't spend 85% of the amount, you set apart the unspent amount for a particular towards the objects of the trust. This is very important to note that the expression used in this particular explanation 3 is that it is for application to such objects. Keep this in mind because a bit later I will explain to you the import of this particular expression, that it is for application for such objects. Then what are the conditions you have to specify? The conditions are almost similar to what we have in section 11.2, or almost identical. You have to file a statement, furnish a statement to the income tax department, specifying the purpose for which the amount is accumulated. Second, the accumulated amount is invested only in the modes approved under section 11.5. Third, the statement referred to is furnished on or before the date for filing the due date of the return under section 139(1), and you have to have the period of 5 years referred to in a period during which the income could not be applied. There's a proviso which says that if the period of 5 years for which you can accumulate is you're not able to spend that money within the period of 5 years because of a court injunction, then that period gets extended. No other extension. Now, so the point is this explanation 3 to section 3rd proviso to section 23C says very clearly that the income which is to the where there's a shortfall of 85%, then to the extent of shortfall, you can accumulate it subject to these 3 conditions. This is similar to 11.2. Then we have explanation 4. The explanation 4 tells us what are the consequences if such accumulation which has been made is not spent according to the stated purpose. Clause A of the explanation 4 says that if the accumulated amount is applied for a purpose other than the objects of the institution, or ceases to be so accumulated for the objects of the institution, this is one situation contemplated under section explanation 11. The second situation contemplated is the ceases to remain invested or deposited in a mode specified in section 11.5 of the Act. Third is not utilized for the purpose for which the accumulation is made. Then the fourth is if the accumulation is credited or paid to another institution as a donation. So if you look at this, these are all similar to what we have in section 11.3 of the Act today with respect to charitable institutions. But there is a very important point to be noted here is this. As I said earlier, if you look at the main clause of explanation which allows you to accumulate, the expression used there is for application to such objects. So here to such objects is the object for which the institution as such has been established. So it is the requirement under the explanation, main explanation is that it is spent for the objects of the institution. And when it comes to explanation 4, which talks about the violation conditions of the accumulated amount when it will be treated, what it says is that first it says that if it is not spent for the objects of the institution or ceases to be so accumulated, this is the first violation. Then the second violation which is relevant for our discussion is what is mentioned in clause C of explanation 4. Clause C of the explanation 4 says the accumulated amount is not utilized for the purpose for which it is so accumulated. Here you look at the language, the purpose for which it is so accumulated. If you look at clause A, it talks about the objects of the institution. If you look at clause C, it says purpose for which it is accumulated. Now, the general meaning is the word purpose for which it accumulated is pretty narrow. It is almost like saying what you say in your Form 10, in respect of 11 saying that I'm going to use it for a building. I'm going to use this accumulation for setting up a research lab in my college, or whatever the specific purposes you say that. Now, there has always been a controversy under section 11.2 as to whether in your form 10, you must say mention the specific, or you can simply repeat the objects of the trust. Some of the courts have held that it is enough if you mention the objects of trust, that is sufficient. Some courts have held, no, they are using the word purpose, which is much narrower in scope, and therefore you must specify the purpose. Okay, so this controversy is there under section 11. The same thing comes here. But here, we are looking at a direct conflict between clause A and clause C of explanation. When you look at a direct conflict between the two, and read with explanation 3, which is the one which permits you to accumulate, my view would be that clause A would prevail. That means as long as you accumulate for the objects of the institution, that is sufficient. You don't even have to say what is the specific purpose. Clause C has to be read along with these two harmoniously, and it has to be read only with reference to the objects, as long and not with reference to a particular purpose. So even if you are given, assuming that statement which you file as a condition for accumulation says it is for a particular purpose, and if you use it for a purpose which is false within the object but not the stated purpose in the statement, there is a possible view to say that it is, you are not violating the explanation. Explanation 4 is not attracted, and you will not lose the exemption benefit on this. So what explanation 4 says is that if any of these conditions are violated, or if any of those violations take place, then such income would be, that accumulated income would be taxed in the various years. So they specify the point of taxation of those years. For instance, if you are not spent the money within a period of 5 years, then at the end of the 5th year, it will be treated as income. That is, for the 5th year, it will be treated as income of the institution. Second, if you invest in a mode other than specified in 11.5, it will be taxed in that year where that violation has taken place. Now, as far as the 5-year period is concerned, you must, incidentally, I will also refer to section 11 amendments wherever similar amendments have taken place. Section 11.3 also dealt with the situations where the accumulated income was not spent for the stated purpose. Okay. There what happened was you had a window of another 1 year extra. Not only at the end of 5th year, but you could also spend that money in the 6th year. And it was actually, if the violation takes place in 6th year also, it will be taxed in the 7th year. This was the crux of section 11.3. Now, section 11.3 also has been similarly amended to what I said regarding the explanation 4 to the third proviso of the section 1023C. That means there also now that 6th year window is gone. You have to spend within 5th year. If at the end of the 5th year, if the amount is not spent, it will become taxable in that year. So this is a very important amendment which has been made in 11.3 and in explanation 4. Then explanation 5 is a provision which says that if you are not able to spend the money due to some reasons, you can make an application to the assessing officer to extend the time, and he can give the extension for which year he is given that? Sorry, one. Sorry, not the extension of time. It is for some other purpose. in explanation 5, I'm sorry, I made a mistake. So explanation 5 says that if the purpose for which you are not able to spend, you can ask the assessing officer to give a different purpose. Now, Chaitanya has made a very relevant point on this. That's what he told me now. He says that if my earlier view that you can spend it for any purpose of the objects of the trust and not for a specific purpose, then this explanation 5 will mitigate against that particular view. Because if I can spend it for the objects of the trust, irrespective of a purpose for which I have accumulated, why do I need explanation 5? So that's what his point is. This is a very valid point. There are two ways of looking at it. One is that reading explanation 4 and 5 together, the intention of the legislature is that you must say for which particular purpose you are giving. Okay. So that is one way, and therefore it is a must that you must specifically state the purpose and not generally for this. Then the problem arises is that is there a requirement at all for me to say that? If you look at explanation 3, which is the allowing section of accumulation, talks only about the objects of the trust. So one way of looking at it, we'll ignore section the explanation 5 and will not bother about it. But I will agree with Chaitanya to say that the intention of the legislature is to make a 1023C institution specify the particular purpose for which the accumulation is there. Reading explanation 5, no other intention is possible, is one way of looking at it. And if you apply that principle of interpretation, you have to say that. But on the other hand, if we say that no, look at explanation 3, explanation 4, clause A, etc., which talks about a violation like this, then why did they talk about explanation A in clause A of explanation 4? Why do I need it? Clause A will be very specific, that's sufficient. That is in accordance with the intention of the legislature. So there is here a bit of a confusion in applying these particular violation conditions, especially for the purpose for which you are accumulating. So there is an issue on that. The next proviso, which is now coming under this, is the 10th proviso. Now, only one point with reference to the explanation 5 and explanation 4, the controversy is that a similar provision exists in 11.3a, 11.3 capital A, as it exists in explanation 5 to third proviso of 1023C. Despite the existence of that, the courts have held that if you simply repeat the objects of the trust in your form 10, you are entitled for accumulation. Possibly one can argue that the court was not presented with the argument of the import of 11.3a. The provisions of 11.3a were not brought to the attention of the court, and therefore those decisions have missed out this important point. Is one way of looking at it, but in the context of 11.2 versus the explanation there is you have to be clear on this, that there is a possible view on this. The next proviso is the 10th proviso. 10th proviso as it exists today says that every 1023C institution, when I say 1023 institution, only those institutions which are mentioned in subclause 4, 5, 6 and 6A. Not the ones mentioned in 1, 2, 3 up to 3AE. All these things are applicable only to 1023C 4, 5, 6 and 6A and not to other institutions which fall under 1023. Please keep this in mind. So when I talk about 1023C institutions, yes, earlier essential, yes, when you look at the 10 proviso, what section 10 proviso as it exists today says is that every such institution should get its accounts audited. Now, this has been amended to say that, to prescribe that keep and maintain books of accounts and other documents in such form and such manner and such place as may be prescribed. So the memorandum would say that we want a better control on this. There is no specific provision saying that books of accounts are not maintained, to maintain the books of accounts, and therefore we want a specific provision. Possibly this is to prevent an argument that I have not maintained books of account. The law does not compel me to maintain books of account. So there is a question of getting such books of account audited. I cannot get a non-existent books of account audited. So therefore the 10th proviso is not workable at all. So in a given case where the institution does not maintain the books of account, possibly it could have taken a stand that audit requirement is not there and 10th proviso almost becomes a dead letter. So to prevent this kind of an argument being taken, they are now prescribed saying also that books of accounts have to be maintained. And such books of accounts have to be audited by an accountant mentioned in section 288 of the Income Tax Act. Similar amendments have been made to section 12A small b of the Act, which is a requirement of the audit for section 11 institutions. There also they have brought in a section saying that all charitable trusts claiming exemption under section 11 should maintain books of account and get such books of account audited. Then the next one is a very important proviso, which is the 15th proviso, which has been amended. 15th proviso deals with cancellation of the approvals granted by the principal commissioner or the commissioner as the case may be. Incidentally, there is an amendment made say that all 1023C approvals will now be given by the principal commissioner or commissioner instead of the prescribed authority. In fact, Chythanya was saying that he was not able to find out who is the prescribed authority. So now they have made it very clear that it is all the principal commissioner or the commissioner who would give their drop the word prescribed authority from 1023C. Now, when you look at this, the cancellation of an approval given by a commissioner to a 1023C institution, there are the commissioner first should have certain information with him which prompts him to take action to cancel the approvals. Now, the first thing is that he has noticed occurrence of one or more specified violations during the previous year. Now, what is a specified violation has been subsequently defined. We will come to that a bit later. So the first thing is the commissioner notices that there is a specified violation. Now, this notice to the commissioner can come from any source. It can be some information which he has received, some anonymous petitions he received, some newspaper reports, or anything which can come, which tells the commissioner that hey, listen, this particular institution is violating the various conditions of 1023C, and therefore I need to start inquiries on this. So this can come from this. The second one is that where the assessing officer under the second proviso to section 143(3) informs the commissioner that during the assessment of a particular institution, he has come across cases where it has violated and which such violations amount to specified violations. Such violations amount to specified violations, then he has to inform the commissioner and wait till the commissioner passes an order on that. The third one is such case has been selected in accordance with the risk management strategy formulated by the board. This is very broadly stated. It doesn't talk about any particular reference to the violation that has taken place. But keeping the overall scheme in mind, even this particular case is selected under the risk management strategy of the board, framed by the board, is something which would suggest to the commissioner that there is a specified violation. Because under the risk management, the board can select a case for any number of reasons. One such reason is the one which is specified in section 148. So therefore, according to us, this selection under the risk management strategy by the board should suggest that there is a specified violation, and based on that, the commissioner can start. So moment the commissioner has information from any of these three sources, which is specified, then what he can do? The proviso says that he can call for documents and information from the institution, or he can make such inquiry as he thinks fit. Now, as far as the documents or information is concerned, that can be asked only from the institution, not from third parties. But when it comes to inquiry, that inquiry can be with reference to a third party also. So the commissioner, the first step the commissioner will do is, as soon as he gets some information from any of those three sources, he will take the first step of either getting the documents and information from the institutions, or he might make inquiries with the third parties. Then afterwards, it says that second clause says that pass an order in writing cancelling the approval of such institutions after affording a reasonable opportunity and for such previous year and all subsequent previous years. So the important point to note is that the commissioner will cancel the approval for the year in which the violation had taken place on all subsequent years, whether or not any violation took place in the subsequent years. This is very important. That means you lose the complete benefit of 1023C exemption if this one is cancelled, the approval is cancelled. Then the second point is that the commissioner should pass such order within the specified date. Now, specified date has been defined in the explanation as the day on which the period of 6 months calculated from end of the quarter in which the first notice is issued by the principal commissioner on or after the day of 1st April 2022, calling for any documents or information for making any inquiry under clause 1 expires. So that means when he issues the first notice calling for the information from the institutions or making inquiry with a third party, 6 months from end of that quarter. It is not 6 months from the date of this one, 6 months from the end of the quarter. According to us, the quarter would be That's what we decided, April, June, July, September. So according to us, the quarter would be April, June, July, September, October, December, and January, March. So the point is, if we receive something, let's say on 25th of March, he makes the first letter writes to the assessee to produce some information or documents. The 6 months will start from 31st March. It is not the quarter starting means the 3 months from commencing from 25th of January. You can't say that quarter ends sometime in April, it ends in March itself. So this is the meaning of the word quarter we are assigning to it in the explanation. And what is important note as far as the specified date is concerned, it is the date of calling for the information, which is under clause 1. We saw that the commissioner passes an order cancelling the approval under clause 2. Whereas he calls for the information from clause by virtue of powers conferred in clause 1. So the date on which the first of the notice, because the commissioner may be asking for more and more information subsequently, but the limitation is always with reference to the date of the first notice calling for such information. But when it comes to enquiry, it can be the starting date of the enquiry with a third party. So whichever is earlier, either calling for information from the institution or making inquiries with the third parties, whichever date is earlier, that will be the starting point for the calculation of the 6 months from the end of the quarter. So this is very important note, because what you have to understand is when you read the subclause 2, which requires where the commissioner is empowered to pass an order cancelling the approval, it does not specifically talk about giving any notice. All it says is that the commissioner shall pass an order cancelling this one after giving a reasonable opportunity of being heard to the institution. This is almost like what the Supreme Court said in Amitabh Bachchan's case in the context of 263. For 263, the Supreme Court said that there is no requirement for any notice to be issued by the commissioner. It is enough if the commissioner gives a proper opportunity, a reasonable opportunity of being heard to the assessee before he passes the 263 order. Same principles will apply here, because clause 2 of this proviso does not envisage issue of a separate notice. It is enough if the commissioner simply informs you through any accepted modes, saying that your case is fixed for hearing on such and such a date, and during the hearing he informs you that why he wants to cancel this and what are your reasons for that. This is the law, but practically it will be very difficult, and more often than not you may get a notice from the commissioner stating the reasons as to why he wants to cancel your approval. But that notice is not relevant for calculation of the time limit. Please understand this, that if the commissioner gives a notice to you saying that these are the reasons as to why I want to cancel your approval, that notice, that date of that notice is not relevant for calculating the specified date. That date of notice is not relevant for limitation. For limitation, it is the first notice is sent under clause 1 asking for documents and information from you. So this is a very important point you have to look at for the limitation. Then, one incidental question that arises on this is that, assuming the limitation has set in and therefore the commissioner cannot pass an order, can he start a further inquiry again? Can he start issuing one more letter saying that, please give me this information again, what he had asked for earlier? According to me, the commissioner cannot do so, because this will amount to the abuse of provisions. The commissioner can issue a second notice only if some other fresh information has come to his notice. On the very same set of facts for which he earlier called for information from you, and by mistake allowed that order to lapse because of the time bar, he cannot start another proceeding by giving you simply a letter and asking for further information on that. So therefore, this will, according to me, he cannot do that. So the department cannot sidestep these provisions and do something indirectly what is not permitted directly. Then under clause 3, what the commissioner can do is that if he is satisfied with your reply, he has to pass an order refusing to cancel. So he will pass an order saying that, but in any case, he has to pass an order saying that, okay, the assessee has replied like this, and I am satisfied that there is no specified violation, and accordingly, we will take a stand that it is entitled to continue the exemption under section 1023C. So this is the third situation which is current. And once he passes an order under clause 2, that is cancelling the approval, or under clause 3, refusing to cancel the approval, then he has to forward that order to the assessing officer. And it says that, I mean, at least the material which I have printed before me says that officer and such fund or institution, it says. If you look at that, the language used is, there is a spelling error. Forward a copy of the order under clause 2 or clause 3, as the case may be, to the assessing officer and fund. So what I feel is that it's not and, it is off. The assessing officer of such fund or institution, etc. There is a small error which will get corrected later. So this is important. The procedure is that the commissioner will give the order to him, and then based on that, the assessing officer will pass the final assessment order. We have looked at the explanation 1, which defines the specified date. Now we'll come to the most important thing. What are the specified violations? It is not that every kind of violation by the 1023C institutions which would enable the commissioner to cancel the approval. They have to be specified. What is the first one? Where any income of the fund or institution, etc., 1023 institution, has been applied other than the object for which it is accumulated. Sorry, for which it is established. So if you, as an institution, spend something which is not for the object for which it is established, then the commissioner can cancel your approval. This is violation of the third proviso to section 1023C. Then you have the one, if the institution carries on a business which is not incidental to the attainment of the objects of the institution, then the commissioner can cancel the registration. This is violation of the 7th proviso. We have one issue. We discussed this very thoroughly in detail on this, and then now there is a prohibition for the 1023C institution by saying that it cannot carry on any business. Whatever is mentioned in the first proviso to section 215 would apply to a 1023C institution also. If you look at the plain wording of section 215 proviso, it says that if any trust carrying on objects of general public utility is engaged in business, etc., then it is not considered as a charitable purpose. So the point to look at is that after the introduction of the proviso, the department view had been that if you carry on any business you are not a charitable institution and there you are not entitled to the exemption under section 11. But the courts have consistently been ruling. Practically, there are no contrary decisions saying that if the business carried on by the trust is incidental to its objects, attainment of its main objects, then the prohibition under section 215 first proviso is not attracted. So this is the law as on date. Anyway, the matter is now being argued before the Supreme Court and it is at the final stage of hearing. Possibly within the next month or so, we may get the authentic view of the Supreme Court, which will be final. Subject to whatever the Supreme Court says on the interpretation of the first proviso to 215. If it is incidental, then the first proviso does not apply. Let us assume for the sake of argument that's the correct law as on date. Now there is another issue. Supreme Court in Tandi Trust 247 ITR says that if the business which is carried on by a charitable trust feeds charity, then such business is incidental. Whether this decision is right or wrong is a different issue. Maybe I think that is also a matter to be considered by the present bench of the Supreme Court, which is considering the first proviso to 215. Maybe they will take a decision on that and say whether Tandi Trust is right or wrong. But if you, for a moment, if you accept that principle, then there is no business which is not incidental. Because whatever profits you earn from the business, the institution or trust is going to spend for the purpose of its objects. Because under the relevant provisions, they are mandated to do so, of the trust deed. They can't spend it for any other thing, whether the act says so or otherwise. So the point today is that this entire proviso to section 215 becomes illusory. But subject to this, one view we can possibly take is in the interpretation of the first proviso 215, what is the meaning of the word business which is mentioned therein, is that it is those business which are not incidental to the attainment of the objects, because the cancellation happens only if you carry on a business which is not incidental to the attainment of objects. The law itself today recognizes that it is so, that you can carry on an incidental business. Since similar provisions have been made in section 12AB also, which deals with the cancellation. So 12AB 4 and 5 have been amended now, which is in pari-materia with what we are discussing now. So therefore, even for the purpose of section 11, one can possibly argue that if you carry on a business which is incidental, whatever be the meaning of the word you want to give that, if it's incidental to the objects, attainment of the objects of the institution, then you are not violating the first proviso to section 215. This is one important point which you have to keep in mind. Of course, there are contrary views to that. I'm not saying that it is not so, but there is a possible stand that can be taken on this, that the legislature itself has recognizes that a charitable trust or an institution can carry on an incidental business. And it is not that all business are prohibited. See, no, that's what I said. If you look at the decision of the Supreme Court in Tandi Trust, in the context of section 11(4)(a) of the Income Tax Act, they said that this is what the Supreme Court said. They referred to the legislative history of 11(4)(a) and said that 11(4)(a) has been amended from a particular date in 1992 or something, saying that it has become more liberal, and they say that under the present conditions of section 11(4)(a), if the business carried on by a trust is incidental to the attainment of his objects, then the exemption is not withdrawn. Okay, 11A4 conditions are satisfied. They didn't stop with that. They went ahead and made one statement. Any business which fits charity is incidental. So if this, what Supreme Court says is right, then that's what I said, there can't be a business which is not incidental. Because every business which earns profits, I will spend for the purpose of the institution or for charitable. So, personally speaking, I have my own doubts about the correctness of this particular statement made in Fund Trust. Okay, but today that is the law, because that is a law laid down by Supreme Court. We can only academically discuss the rightness, correctness or otherwise, but we have to follow it. Department has to follow it, every court has to follow it. So therefore, as long as it stands today, we can say that everything is incidental because I have applied it for my objects. Next. Now we'll come to the specified violations. One is we talked about not spending it for the object for which it is established. Two, we talked about the books of accounts and audit not being carried out. Then any activity of the funds or institution, trust, any other educational institution or any other hospital or medicine is not genuine or is not being carried out in accordance with the objects of the institution. This is similar almost to what we have today in section 12AA, 3, or which are relevant provisions in section 12AB also on that. The fund or institution or trust, etc., has not complied, this is very important, has not complied with the requirement of any other law for the time being in force, and other directions or decree by whatever name called, holding that such non-compliance has occurred, has either not been disputed or has attained finality. So what happens? Let us say that an educational institution, a medical college, etc., has to be approved by various authorities, and they specify the conditions on which the approval will be given, where you have to meet those conditions for getting to run your engineering college or your medical college. If there is a violation of any of those conditions, authorities under those statutes can take action against you to whatever is, let's say point of violation, they may levy fine, they may cancel your license, whatever it is. But as long as it is a violation of any decree, etc., given by the other authority, other statutory authority, and such order is not being disputed by the institution, or if it is not, or if it has attained finality, then your registration or approval can be cancelled. So the commissioner has to wait. It is not the commissioner who is going to take a decision whether you have violated the conditions for say, establishment of an institution. It is the authority under the other law who has to take a decision, and such decision should not have attained finality or should not be under dispute. So if you have filed a writ petition or something which is pending, until the matter is decided by the courts, you cannot do that. On the other hand, without disputing, you settle it by paying the relevant fine or penalty or whatever it is. Then, though your license and the other statute may continue, under the Income Tax Act, your approval under 1023C can be withdrawn. As I said, similar provisions have been made in section 12A capital AB. So even a charitable trust will face the same. This especially when you have some educational institutions is what will be hit more often than not. Then there is another small explanation which is not much. not very well. What it says is that today you have a proviso to section 143.3, sorry. You have a proviso to section 143.3, which says that in the case of various institutions mentioned therein, which include 1023C institutions, the assessing officer notices that you are not entitled to the exemption under section 23C, then he can make a reference to the prescribed authority at that time and ask him to cancel the approval. Now the law says that if any such reference has been received from the assessing officer prior to 31st March 2022, such reference shall be deemed to have been received under the current proposed provisions, and the commencement date is 1st April 2022. It shall be deemed to be on that date, and the commissioner can proceed further with the inquiry, etc. Okay. So this is very important, that the existing reference made under the first proviso to section 143.3 would also be a part of the cancellation provided in this proviso. When it comes to section 11, there is no similar proviso. When you come to section 12AB, etc., there is no similar provision because it is not needed. Because the first proviso, as it stands today under 143.3, does not refer to a section 11 in trust. So in the case of a trust, if the officer notices violation, he can straight away pass an order under section 143.3 denying you the benefit of section 11. There is no mandate on his part to refer it to the commissioner for cancellation of registration and wait till the commissioner passes the order. So that is why you don't have a transition provisions like what provided in the explanation in the case of charitable trusts, which are exempt under section 11. But post 1/4/2022, whenever the assessing officer wants to make an assessment on the charitable trust denying exemption under section 11, and if he notices these specified violations, what we have discussed them, if he notices these specified violations, then he has to make a reference to the commissioner asking him to cancel the registration under 12A(b)(4) and then wait for the order of the commissioner before he passes the order. Before we go to the other, this one, do you have any questions, or any questions have come from? Yes, sir. Yeah, it's a very good question. See, the question is this. If
ಒಂದೇ ನಿಮಿಷ ಸರ್, ಒಂದು ವೆಹಿಕಲ್ KA05 MT 5368 blocking all the traffic. Anyone's here? KA05 MT 5368. Please remove that.
the question is this. If the commissioner notices violation for one particular year, okay, is he duty bound to cancel the registration for that year and subsequent assessment years? Because the section is very clear. It says that he shall cancel the approval for that year and subsequent years, and all the subsequent years. So therefore, there is a clear mandate given by the law that irrespective of the fact whether there is any specified violation for the subsequent years, the cancellation will become effective. Now we had a discussion, because this is what I wanted to come now. Since you have raised that question, I will say, we had a discussion on this, how to get over this for the subsequent years. There is a possibility that, suppose let us say that the commissioner passes the order on sometime in June 2022. And the violation happened in sometime in February 2020. So it will be the assessment year 2020-21, assessment year 21-22, and 22-23 will be covered, and subsequent years also. So any assessment year falling after 2021 will be covered because the registration will not be effective for those years. So in June 2022, I make an application to the commissioner again fresh. If I'm a 1023C institution, I make it under the first proviso to section 1023C or as envisaged in section 12A AC. When I make a first time, again a fresh application for registration, either under section 12A or under 1023C approval, the commissioner is bound to give me a provisional approval. A provisional approval given therein can be cancelled only if the specified violation is after that. Suppose I make an application today as for the June 2022, as in my example, that application will be valid from assessment year 23-24 onwards. Okay. Then the relevant provisions of the first proviso to 1023C or section 12A AC would say that I have to make a final application for final registration 6 months prior to the expiry of the provisional registration or when I commence my activities. The law as it stands today envisages that a 1023C institution or charitable trust would seek a provisional registration only when it is formed for the first time. Only at that time, in that year, they will make an application. That is why they are given this provisional, this one's expiry of 6 months prior to the expiry of the provisional approval or the commencement of the activities of the trust or the institution, as the case may be. Now, whichever is earlier. So you have to make an application. Now, what happens in this case? I have commenced my activity long time back. So if you apply that particular clause for this one, very strictly speaking, I can't apply for a final registration at all, because I have already commenced my activities and the 6 months time has lapsed long time back. So there are two ways of looking at it. One is that the section is very clear. There is no scope for any other interpretation, and hence that condition is not satisfied. You will never get your registration under section 12A or under approval under 1023C once your registration is cancelled. This is one view. The other view is the later clause of the time limit with reference to the commencement of the activities of the trust is not applicable to you, because you are an existing institution or a trust carrying on an activities, and then let us take a case where you are not applied for so many years. Forget cancellation. You are not applied for so many years for whatever reason by mistake. You apply for the first time now. That 6 months time limit cannot apply for you ever. So therefore, on that basis, it is possible to argue that on a reasonable interpretation, the time limit only will be with reference to the expiry of 6 months of before the 6 months before the expiry of the provisional approval. So only that time limit is applicable, not the later time limit. If that is the case, at least from assessment year 23-24, you will get the benefit. Please use a mic, sir.
Once the registration is cancelled, automatically 115 TD will get attracted. Once the registration is cancelled, whether 115 TD immediately get invoked?
115 TD.
Yeah, yes.
I'll come to that because the 115 TD amendment also is there. I will take it at that time.
Okay. Other issue is this specific violation doesn't include benefit to the related parties. Benefit to the related parties. Is it a reason for the cancellation? It can be, because the general clause says any amount spent for expense other than the object can as a reason for specific violation. Whether they, but benefit to the related party is not specifically given as a violation. In the
Sorry, I'm not
violation.
able to follow the question. Talk about 13(1)C, 13(1)D violations. No, that's okay. That is true. No, two more are added for the one is that private trust and other is 13(1)B. Not this. 13(1)C, 13(1)D are not covered by that.
11.5
13(1)C and 13(1)B are meant only for the relevant income being extra, not
benefit to the related parties
Sir,
and investment both are not shown as a specific violation.
See, as I understand, the question is that if there is a violation of 13(1)C or 13(1)C, that you have applied your income for the benefit of the prohibited persons, whether this one can be cancelled. Your registration can be cancelled. According to me, the answer is no. (22) nali barattala. 22 nali is specifically covered. So, very income derived from property housing only on. Okay. So one view is that because the section also says that since you have applied the income for the purpose for the other than the objects of trust, you have done that and hence there is a violation and therefore it can be cancelled is an issue. But what I am saying is that if you look at the 22nd proviso to section 23C and also the amendment to section 13(1)C, it talks about the relevant income only being taxed. So if the relevant income is going to be taxed under the 22nd proviso, whether cancellation also would apply under this is an issue. Okay, Chythanya says there are two different things and therefore one is a cancellation, the other is a taxability. The taxability will happen as per the 22nd proviso and this will happen as per this. But one way of looking at possibly the argument is that since it only that part of the income is being taxed separately and not my entire income is taxed under that section, under the 22nd proviso or with section 13(1)C, the cancellation will not happen. Is an issue, but prima facie it is better to take the view that if you violate 13(1)C, the cancellation will happen. So it is better to be safe than sorry. See, these are all only matters of defense. But today the intention of the government is very clear that they want to have a very tight control over the 1023C institutions and section 11 institutions. So it is better to be careful and avoid this problem altogether rather than trying to take a shelter under certain interpretation clause because we never know how the courts will interpret finally. Because gone are those days where we can say with some amount of certainty that this will be the approach of the court. Today, it all depends on the individual judge who is deciding it. It is not even, may not be based on law. It is on his perception of law. That's a fact, because everybody is a human. So it's better to be careful on this, because I would rather tend to agree with Chaitanya on this point, saying that yes, if you do that, it comes under the omnibus clause of not spending your income on the objects of the trust. Okay. Then the.
So one question. Yes, sir.
Who is that, please?
With amendments being made to 1023C to almost bring it on par with section 11, do you see any material difference while one is evaluating 1023C versus benefit under 11? Let's leave the materiality based or government funded ones out of.
I wanted to address this issue at the end. Okay. There are two. The question is this. If you look at section 1023C conditions and section 11 conditions, they are now almost same, identical. So are there any differences? Second, if there are no differences, why have 1023C at all? We don't need 1023, 4, 5, 6, 6A. Previously, at least I had, as an assessee coming under 1023C, I was out of the rigors of various sections 12 to 13. Whereas today I am not. So therefore, prima facie, there exists no reason as to why you have two separate regimes. They can be clubbed under section 11 and be done. Section 1023C for these institutions can be removed. This is one way. The question you asked me is whether there is a difference. There is one difference. At least what I could notice is one difference. If you look at section 12A to proviso, which says that where for any pending assessment, the exemption under section 11 could not be claimed because you are not registered under section 12A or 12AB now. That exemption will not be denied only for that reason if subsequently you are granted registration. Similarly, they also say that if you are subsequently granted registration, no action under section 147 can be taken to reopen your past assessments where you are not registered, when you are not registered. Now, these similar provisions are not there in 1023C. So this is the only difference I can find out.
So one other question, sir. Here again. Going back to the point on provisional versus final registration, the form for final registration has been while it has been notified, the income tax portal has not enabled that as yet. So for trusts or institutions which, let us say, it started prior to March 21 and had made an application, provisional application, and got transitioned, they were all issued provisional certificate. Let's say they've commenced activity and the period of 6 months has transpired or has already expired. What is that these institutions should...
You have a problem with the portal in uploading the application?
It is
for
not
final
available.
Application?
Not available on the portal, sir.
So then what is the problem? You say that until it is done, either the board will issue a circular saying that we are condoning the delay, okay, or even if they tomorrow if they say that the application is time barred, you can always file a writ and say that it is not my fault. So you can't penalize me for your fault. So it's very unlikely that the department will deny you the final registration on the ground that this one. But anyway, this is not something which comes from the
Not
budget.
this budget. Yes, sir.
Okay. So I request, because we are already running late by about 45 minutes based on our schedule. So I request all of you to kindly confine to the Finance Bill 2022 and the attendance issues, and not various connected issues with that. Then the next thing is that, as I have said, that 19th proviso has been amended. This is nothing, the only amendment in 19th proviso instead of prescribed authority, they brought in the principal commissioner or commissioner as the case may be, so that the there is no other issue, then we don't need to discuss 19th proviso because the existing proviso has been amended only for the purpose of to include principal commissioner or commissioner. Then after the 19th proviso, we have the 20th proviso. The 20th proviso requires that you have to file the return. To claim the exemption, you have to file the return within the time specified in section 139(4)(c). As you know, under section 139(4)(c), these institutions have to file their return of income, and that has been filed within the time specified under section 139(1), and hence the same thing has been made here, saying that if you don't file the return, you don't get the benefit. After the 20th proviso, you have the 21st proviso, which has been introduced. It says that where the institution, the income of the institution has been applied directly or indirectly for the benefit of any person referred to in subsection 3 of section 13, such income or part of income or property shall, after taking into account the provisions of subsection 2, 4, and 6 of the said section, be deemed to be the income of such person of the previous year in which it is so applied. So what happens if you apply your income to a prohibited person for the benefit of a prohibited person? It can be application of income or it can be application of property. Then the relevant portion of the income will not be exempt. Is that clear? Now, previously there was a doubt as to whether when you violate section 13(1)(c), whether your entire income will be denied the exemption under section 11 or 1023(c). 1023(c) had no such provision, but the entire income will be taxed under section normal provisions as far as the charitable institutions are concerned if you violate 13(1)(c). The decision of the Karnataka High Court in Father Muller's case said very clearly that it is only that portion of the income which is attributable to the violation would be taxed, and not every income which is otherwise exempt. So therefore, that Father Muller's principle now has been legislatively recognized, and say that in case of violation of section 13(1)(c), you will have only the relevant portion being taxed and not the entire income. So this is a welcome amendment, and possibly we can use this even earlier to say that it is a clarificatory amendment, because it clarifies the law. It is brought in accordance with the decisions of the court, and there's a possibility to argue that it is a clarificatory amendment. The next one would be the 22nd proviso. What 22nd proviso says is that in the case of a 1023(c) institution, if there are violations of certain specific conditions, the income chargeable to tax arising from those violations would be taxable, and how such income is be computed. What it says, suppose you carry on a business in violation of the first proviso to section 215. Whatever the meaning you want to give that, we'll assume that there is a violation. Or the books of accounts, audit, etc. Books of accounts are not maintained, audit is not carried out as required under the 10th proviso. Then under the 20th proviso, if you don't file the return in time under 139(4)(c), then under these conditions, the exemption is denied, right? Then when the exemption is denied, the 22nd proviso says how to compute such income. The proviso says that the income chargeable to tax shall be computed after allowing deduction for the expenditure other than capital expenditure incurred in India for the objects of the fund or institution or trust, etc., subject to the fulfillment of the following conditions. What are those conditions? First is such expenditure is not out of the corpus standing to the credit of the institution. Second, the expenditure is not from any loan or borrowing. Third, the claim for depreciation is not in respect of an asset for which which has been claimed as an application of income in the earlier years. Then such expenditure is not in the form of any contribution or donation to any other person. So a third party donation given by the trust or institution will not be. Therefore, if you are looking at these three provisos, you want to compute the income from the from that income, the only deductions, any expenditure not being capital expenditure, let us assume for sake of convenience, we'll call them revenue expenditure. Revenue expenditure for the objects of the trust. Second, the expenditure will be allowed subject to those conditions that it is not out of the corpus. Third, no depreciation will be allowed if already an application has happened earlier. Then the expenditure is not incurred out of a loan or borrowing, etc. So the first important question to arise is, what is that income chargeable to tax? What is the starting point for the 22nd proviso? Now let us take a case of a business, because that is specifically provided for here. If you want to deny me the exemption in respect of the business profits, how do you compute it under 22nd proviso? Is it that I will take the gross receipts of the business, whatever be them sales or any other service receipts, I will not allow any deduction? Because all those expenses incurred for the purpose of business are not incurred for the purpose of the objects of the institution. They are incurred for the purpose of the business, not directly connected with the objects of the institution. So I will not allow any of those things. So practically the gross income will be taken. From such gross income, I will allow the expenditure other than capital expenditure, which are spent for the purpose of the meeting the objects of the institution. This is one view. This, according to us, is a very harsh view. It is not right. The correct view is that because it is using the expression income chargeable to tax, you have to compute the income in accordance with the normal provisions of the Act. In this case, apply section 28 and 29 to 43C, and then compute the income under the head business or profession. From such income, you deduct the expenditure which is not claimed there, the revenue expenditure which is not claimed there. Now let us just take, for a sake of argument, that a hospital carrying on charitable activity or a medical relief institution, okay, because the same similar provision is made in section 11 also, a medical relief institution has carried on certain business which is not incidental. Okay. It has also incurred certain expenses in the form of medical relief, which are revenue expenditure. For instance, they conducted a camp. for carrying out a cataract operation or for carrying out anything, or in the case of COVID, they gave the COVID medicines, etc. These are all for the purpose of the trust. So the second view is that you compute the income under the head profits and gains of business or profession. Since these expenses are not allowable under those sections, you claim it separately while coming under the second proviso to section 22nd proviso to section 23C. Also, the similar provisions have been made in section 139, section 1310 in respect of a charitable institution. 1310 and 11 have been made. So this is one way of looking at it. But then the problem, there is a varying of the pitch. If you look at 23rd proviso, which is proposed to be introduced, it says provided also that for the purpose of computing the income chargeable to tax under 22nd proviso, no deduction in respect of any expenditure or allowance are set off, or any loss shall be allowed to the assessee under any other provision of the Act. If you literally read this 23rd proviso, whatever I said secondly is not, you cannot claim. Take the gross receipts and only claim that COVID expenses or any other medical camp expenses in my example. But we had a consensus on this. We thought that this 23rd proviso is an overkill, because whenever there is this one, the legislature has started introducing these kind of provisos and sections prohibiting allowance of expenditure, and so that doesn't mean that it is a gross which is to be taxed. After all, the subject matter of taxation is income. One should never forget that. No doubt, the Income Tax Act can artificially define income, can artificially compute your income, but the question is such that can your whole gross receipts be deemed to be income and taxed? So again, what I would like to say is that since the interpretation which could be placed on the 22nd proviso can be so devastating that your entire gross receipts can be taken as a starting point, and only those expenses, revenue expenses connected with the objects of the institution will be being allowed. Be careful about doing any business. Similarly, when you come to one, at least here I can take a for business income, I compute that only that portion of income and then come to that. Take a case where I have belatedly filed the return under 139 posts, not filed within the time. Now, no expenditure will be allowed except revenue expenditure. Does it mean the entire gross donations or whatever the gross receipts of the institution have to be taxed? So this is a serious point on the 22nd proviso, which needs to be addressed, and one way of looking at, and we hope that either the board clarifies later that the normal expenses would be allowed, because even an institution can have certain revenue expenses which need not be considered as for the purpose of the objects of the trust. And the other expenses may be, or revenue expenses may be for objects of the trust. In a given case, it is possible to argue that all expenses are only for the objects of the trust. Take a college. You go through the debit side of the profit, income and expenditure account. I don't think you can find anything which is not for the revenue expenditure, which is not for the objects of the trust, but which is also incurred for arriving at the net income. So like take salary paid to the lecturers, examination fee paid to the university, all other incidental expenses of the college. All are only, including rent, printing and all administrative expenses are only towards the objects of the trust. That is education. You can't provide education without incurring those expenses. They are essential. So I can always argue that all these are revenue expenses for the purpose of the objects of the educational institution, and therefore you have to allow me the deduction even under 22nd proviso. But such a possible argument may not be available in every case. So therefore, we hope that board will clarify the point on this very clearly and say how incidentally, this is one of the amendments which is supposed to clarify the doubts. This creates more doubts than it ever existed. Then both under section 11 and in 1023C, an explanation has been added. The explanation says that when you want to compute the application of income, the amount which is applied by the institution, which is allowed as a deduction, how do you compute? Now they are saying that you have to compute it on cash basis. As you know that the certain courts earlier held that even if there is a liability to incur certain expenditure which can be treated as an application, depending on the method of accounting followed by you, you can claim it as a deduction. A promise to pay a donation, a binding promise to make a donation was allowed. So a provision made in the books was allowed. Though I am of the personal view that I have always been advocating this view that application by its very nature can only be actual outflow. Unless there is an actual outflow, application cannot happen. And the entire income under section 11, etc., needs to be kept computed keeping this in mind. And you can't have, because what is exempt is income which is applied, not everything which is applied. If the source of such application is other than income held under property in the trust, it is not will come under that. If you borrow money and spend, the expenditure incurred in that year out of the borrower is not application. The subsequent year, when you repay the loan out of your income, that may be application, but not in the year of spending. The expenditure itself may not be application, but this was not accepted based on various decisions. So, but today the explanation to section 13 or 1023C and section 11 makes it very clear that the application has to be computed only on the cash basis. As I said, wherever similar amendments have been made in section 11, I have already referred to them. So therefore, whatever is done under 1023C or applicable to section 11 also, just to repeat what I said earlier, today, in my opinion, there is no justification for having two regimes of exemption. Everything can be combined under section 11. So that we don't have a 1023C institution need not worry about all these things. 1 year you are there, it is also permissible to hop in and hop out of this 1023C and section 11, etc. So therefore, it is better to have only one, section 11. That is sufficient. And then the difference, today the difference after the Finance Bill 2022 is that the benefits given under the proviso to section 12A2 is not applicable in terms of 1023 institutions. Then we'll come to section 115 TD, the accretal income, or what is popularly called exit tax. Whenever earlier 115 TD was applicable only to charitable institutions which are registered under section 12A, it was not applicable to 1023C institutions. Under section 115 TD, under certain circumstances, the institution, the trust registered under section 12A have to pay a tax on the accretal income. Accretal income was basically nothing but the market value of all its asset on the date on which a particular event happened, and minus the liabilities existing on that date. On the balance amount, you pay 30%. This is almost like a section 115 in one sense, is that no order need to be passed by the assessing officer. On the 14th day after the occurrence of the event, you have to automatically pay. So this is the existing provision of section 115 TD. Now they have, instead of making the situational amendment wherever it's required to include the 1023C institutions on 115 TD, they have practically rewritten thereby saying that it will apply to specified institutions. Specified institutions means an institution which is registered under section 12AB or approved under section 1023C. Other than that, practically there is no difference on this. Earlier, a question was asked whether 115 TD would apply if a registration is cancelled. The answer is yes. Section 115 TD says that one of the things is that if the institution converts itself into a form which makes it ineligible for exemption under section 23C or section 11, then section 115 TD will apply. The definition of conversion into another form is there in 115 TD, which says that if the registration is cancelled, then it deemed to be converted. It is not only voluntary conversion from a charitable institution to a non-charitable nature is covered, but also a cancellation of registration, a cancellation of the approval today under for 1023C also will fall under 115 TD. Only one point I would like to make here is that one of the things says is that you can, if you merge any entity other than an entity which is a trust or institution under 1023C or section 11, then there should deem to be an accretal income will happen. Okay, that is one of the triggers for charging accretal income to tax. That you merge with a non-charitable entity. We'll put it just for the sake of simplicity, I'll use that expression. You merge with a non-charitable entity. But the way the clause is worded, a cross merger between a charitable institution and a 1023C institution or vice versa is not prohibited. Suppose a charitable institution gets merged with a 1023C institution or vice versa, there is no accretal income on that. That is permitted only if you merge with an entity which is not a charitable entity or which is not a 1023C institution, then only you will attract this particular disqualification and accretal income will happen. Then consequential amendments have been made to 115 TTE, which is with reference to interest. If you don't pay the amount within 14 days, you have to pay interest on that 115 TTE. So they have said instead of a trust registered under a particular section, they made it a specified person. Similar amendment has been made to 115 TF also. They are consequential. There is nothing much to discuss on that. Then we have to discuss two more provisions. One I have already briefly touched upon, that section 143 second proviso. 143 second proviso. It says that, I'll just briefly explain that if the assessing officer during any proceeding finds that there is a specified violation, then he has to send a reference to the principal commissioner to withdraw the approval or registration, and no order shall be made making no assessment order can be passed until the commissioner decides the issue, either cancelling the registration or refusing to cancel the registration. If he cancels the registration, assessment order will be passed accordingly. If he refuses to cancel registration, that will be taken into account. The final assessment order will be passed. And the section 153, which gives you the limitation for passing the assessment order and under what circumstances the limitation will be extended, has also been amended to say that the period during which the assessing officer refers the matter to the principal commissioner till the receipt of the order by the AO from the commissioner would be excluded for the calculating limitation. Because otherwise he has to pass the order within 9 months from end of the relevant assessment year. That becomes a serious problem. 12 months now. It will be extremely difficult for him to do that. And therefore, it has been made very clear that he has to wait for that particular period is excluded under section 153. Now we will come to 271A. We will take it in the second round. No, better. That's what I'm coming to. So 271A, I'll take to 115 BBI. I know. The next important provision is 115 BBI, dealing with the charitable institutions and the 1023C institutions. Sorry, can you just remove your mask and all that? See, I have a problem of hearing, so it's a bit difficult. That I think we'll finish it. Another 10 minutes we'll finish it. No, because I thought that our session will be so interesting that you will not even think about lunch. Sir, we'll just finish this. I think it's better to finish this because we are, as we said, no, otherwise I'm sure we are going up to 7 o'clock. I don't want to go beyond 7 in the evening. Under section 115 BBI, in the case of a charitable trust or section 1023C institution, certain income are being taxed at the rate of 30%. They are called specified income. What are those specified income? One is an income accumulated or set apart in excess of 15% of the income where such accumulation is not allowed under any provision of this Act. For instance, you have not spent 85%, you have spent only 65%, so the 20% you can accumulate. So you have to, if you want to accumulate, you have to fulfill certain conditions. You have to file the statement, you have to state the purpose. We saw the attendant controversies on what is the purpose, etc. And therefore, if you don't satisfy those conditions, the accumulation is not allowed and it becomes taxable. So if that portion of your total income, which is which is equal to the accumulation, which is not allowed under the provisions of the Act, is be taxed at 30%. This is one category of specified income. Then the second category is deemed income referred in explanation 4 to the third proviso to section 10 and 10b. We saw that where the accumulated income is not spent for the stated purposes, okay, then it will be taxed. And we also said that in which year it will be taxed. Such income, whether it is coming under the explanation 4 to third proviso or under section 11(3) of the Act, would also be a part of the specified income to be taxed at 30%. Then any violation of the investment conditions would also attract, any income therefrom also will attract 30%. Then any income which is applied for the benefit of the prohibited persons, thereby attracting section 13(1)(c), would also come under the 115 BBI as this. Any income which is not excluded from the total income under clause 11(1)(c) of the Income Tax Act. The 11(1)(c) is with reference to, generally, instead of going and explaining this, I'll say that it is with reference to some application of income outside India. Because under section 11, you have to apply the income in India and the purpose. And therefore, if you apply any income outside India, then you are not entitled to exemption for that. And to that extent also will be coming under the specified income. The aggregate of whatever is mentioned in A to E in section 115 BBI will be taxed at the maximum marginal rate of 30%. Okay. The one important point is that whether 115 BBI will apply to registered trusts only, or will it apply to unregistered trusts also? See, important thing is notice that there is no overlap between the specified income here and the specified violations we saw in the 15th proviso or section 12AB. There is no overlap on that extent, by and large. So therefore, what happens is in these cases is that suppose a trust is unregistered. Possibility it was never registered, or it was registered and then the registration was cancelled. In such cases, whether 115 BBI will apply. For instance, take a case where the registration was in force. I was allowed to accumulate the income. And section 11(3) is attracted afterwards because I have violated some of the conditions. So therefore, under section 11(3), it is deemed to be the income in the year in which the violation has taken place, or the 5th year if I have not spent the amount. But in the 5th year, I am not coming under section 11 at all because I am not registered. I might be liable under 115 TD for accredited income, etc. That's a different matter. So once I am not registered under section 11 or approved under section 23C, my income is to be computed in accordance with the normal provisions of the Act. So none of these sections will apply. So one view is that since my income is not computed under section 1023C or 11, or no exemption is claimed under that, I am not an unregistered charitable institution or a 1023 institution does not fall under 115 BBI. This is a possible view. Chythanya was also saying that if you do that, then there will be a problem between a trust which was never registered and a trust which became unregistered subsequently because of cancellation of the registration. He said this could be a a hostile discrimination because two unregistered trusts are being treated differently without any reasonable classification, thereby violating Article 14 of the Constitution. So this is one possible view on this. So, after an extensive discussion on this, we had a consensus saying that 115 BBI will not apply to an unregistered trust. Even if you want to tax it in accordance with the income, the 11.3 income, it will be done under normal provisions and you will have to do that. The second issue is certain income which are mentioned here also may fall under the relevant income as defined in section 164(2). 164(2) talks about in the case of a charitable institution or 1023 institute whose income is not exempt, then if it is has a certain characteristics specified in 164(2), tax on such income is maximum marginal rate. Today, there is absolutely no conflict because whether you tax it under section 115 BBI or apply section 164(2) in respect of such income, the tax rate is 30% because today MMR also is 30%. Even under 115 BBI is 30%. Let us assume there is a variation. There is a possibility tomorrow that the maximum marginal rate can increase to 40%. Or the maximum margin rate more likely to come down to 25%. So when it comes down or when it gets varied, what happens? There is a conflict between 164(2) and 115 BBI. Suppose the variation is in favor of the assessee, we may possibly argue, applying the Vatika principle, that a provision which is more beneficial to the assessee should be done, should be taken into account, and therefore the lesser rate should be applied. Similarly, if it is more than 30%, we will say 164(2) will not apply because 115 BBI is more beneficial to me. This is one way of resolving the conflict, that you apply that rate which is favorable to the assessee based on the general principles of interpretation. We'll stop that. Okay. Are there any questions on this? No, surcharge is not included in 30%. Anyway, that is, you will have to pay surcharge and cess separately. So we will, are there any questions? No questions. Okay. Yes, sir. Yes. No.
Sir, you referred to income computation of you referred to the income computation for educational trust, where various expenditures are incurred. The expenditures are incurred on the by the educational trust. They could fall in two categories. One is actual application of income towards charitable purposes, and one could be an expenditure incurred as a matter of obligation for the revenue that was generated. So when we do the income computation for educational trust, should we consider that part of expenditure that is incurred to earn income and compute the income and then compute the application, and how the 85% will be computed, whether 85% will be on the net income or on the gross collection? How that mechanism would
be? As far as, no, that is on the basis you are assuming that the net income under the other head has to be taken into account for the 22nd proviso and then give the deductions provided therein, correct? Assuming that is there, then the question is that when you are going to compute your section 11, 15%, the standard deduction which you get under section 11, is it on gross receipts or on net receipts? Okay, so the point would be that according to me, it should be on gross receipts, but it should not include what is computed for the purpose of the gross receipts should not include those which are coming under the 22nd proviso. That is one view. Because there is no clarity on this.
Deduction which are allowable. Let's assume if the trust has a business income and there are certain deductions that are eligible under the head income from business, then those expenditure can't be considered for the 85% spending because you'll take the net business income and then apply for charitable purpose.
I agree with you 100%. See, my view is that if you look at section 11.1, this is something not of the budget, but let us say very clearly, 11.1 uses the expression income. Income has to be applied. And where you don't apply 85%, it says what happens. So the income cannot be gross receipts. But based on that Supreme Court judgment, was some communique something, 201, huh? 248 ITR 1, where they said that it is on the gross receipts, 15% in gross receipt. And today, in all the tribunals, especially in Bangalore, and I think even the High Court also is in decision, I'm not very clear on that, are holding that 15% you have to calculate with reference to your gross, in the case, let's say donations or a gross receipts. So if that is there, you can still claim on that, but the interplay between the section 1310 or the 22nd proviso 1023C read with 11.1, 15%. One possible compromise could be that these gross receipts should be excluded and balance gross receipt take 15%. And what happens is you look at section 22nd proviso, you look at the 22nd proviso, it doesn't even give that 15% bandwidth because it only says that income chargeable to tax should be computed in the following manner. The only expenditure it allows is the revenue expenditure which is treated as application. So therefore, and section 1310 also is not subsequent to section 11. So therefore, the 15% standard deduction may not be available with reference to the income referred to in 22nd proviso. So the question of whether it being gross or net does not arise. Only the other income you may take on a gross basis.
So one more question. Where you accumulate the expenditure which is falling short of 85% for a certain period and you do not utilize it for that period, in the year of expiry, it is deemed to be income for that year. In that year, if you apply it for other purposes, can you take an exemption? In the light of this new tax regime, what will
again, this is not something which comes out of the budget, but I will answer it in one way. We have discussed
in
this.
the light of this section.
No, we have analyzed this in the context of section 11.3 and come to a conclusion that this income under section 11.3 has to be taxed separately. It cannot be treated as income of the current year, which is available for your application. That is the view we have taken in a different context in 11.3. So therefore, the answer is no. So we'll meet after lunch. Father? Okay. The lunch time is half an hour. So at the end of half an hour, your plates will be confiscated.